The internet forms part of almost every facet of our everyday lives, and the way we access it has become predominantly mobile. Financial services is no different. Firms engage with their clients on a 24/7 basis via mobile technology. Not only are firms bringing products and services to market that are more personalized, but new technology has also changed their internal operations. This is increasing efficiency across the entire value chain, as well as lowering costs in certain areas. As financial services look to the future of innovation, many are also enhancing their operations through advances in data processing and analysis, DLT, AI, cloud-based systems, IoT, and Web 3.0 applications. Luxembourg offers the ideal location for fintech firms looking to expand their product offering among finance firms. This is due to the unique position it occupies as a global hub for private and corporate banking, fund structuring, client servicing, insurance and payments, a true B2B fintech ecosystem. Beyond this, the Grand Duchy also offers fintech firms a platform from which to offer their services across the European single market. The most successful path forward for bringing true innovation to financial services is through cooperation between incumbents and fintechs. Luxembourg is at the heart of this.
Welcome to the Digital Finance Forum, bringing together thought leaders and financial experts from across the globe to share their insights on how innovations are revolutionizing the financial landscape.
Ladies and gentlemen, good morning, good afternoon and good evening, wherever you are in the world. A warm welcome to this inaugural edition of the Digital Finance Forum, coming to you live from our studio here in the European Broadcasting Centre in the heart of Luxembourg. My name is Judith Bogner and I'm truly honored and delighted to lead you through this event on behalf of Luxembourg for Finance. First up, we would like to express our gratitude to our sponsors who help us to make this event happen. We also thank all our expert speakers who set aside time to join us and share their insights with us. And we thank all of you who are joining us from around the world, from more than 50 countries. Now, this, of course, will be recorded and the recording will be made available to you. Just look out for the email in your inbox after the event is over. It will have a link that will take you right back to the recording here on the website of Luxembourg for Finance, where you're watching right now. So finance is on the verge of a huge leap of transformation. I perceive it both as a digital evolution and revolution because thanks to innovation, as was just mentioned in the introductory video, finance is likely to become more immediate, more accessible, more democratized, if you will, while at the same time being able to reduce certain costs and minimize certain risks. Of course, it also takes investment into infrastructure, into talent, and there's also the need to develop suitable new guardrails as far as supervision and regulatory oversight is concerned. And I think we can all agree that in that regard, the bankruptcy of crypto exchange FTX back in 2022 was a wake-up call for supervisory authorities and regulators around the world. And indeed, it prompted the European Union to introduce what some might consider the world's first comprehensive crypto regulation, known as MiCAR, the Markets in Crypto Assets Regulation. And yet, despite the continued caution around crypto products, we saw yet another watershed moment for the industry, when in January this year, the US SEC approved 11 Bitcoin exchange-traded products. So you see there's a lot of dynamism in this landscape of digital finance. And over the next 3 hours, we're going to cover this evolution from the most pertinent angles. We're going to start it out with a conversation on how global payments are going to be simplified or are being simplified already with the help of DLT. Our two panels are going to address how digital assets are reshaping capital markets. And then we're going to look at how crypto regulation is evolving in different parts of the world. Next, we chart the trajectory of what we now know as open banking to open finance. And then we take a deep dive into how generative AI infrastructure is being built out in the financial sector with some very practical examples. And we'll wrap it up with a hard look at the surge of cybercrime that is threatening the financial sector and how to build cyber resilience. But first, we're going to take a high-level perspective with our keynote speaker. Now, his professional journey actually started out in the world of policy making when he became a research assistant in the office of the UK's Prime Minister. From there, he found his way into banking as an equity analyst for Citi back in 1997. And then in 2009, round about the time of the last financial crisis, he became Citi's global head of banks and fintech research. And since 2021, he leads Citi's Future of Finance team, which sits at the intersection of the future of money, finance and emerging technologies. Now, alongside his role as Citi, he also is an advisory board member at the Centre for FinTech at the Imperial College Business School in London. And he's also on the advisory board of various tech startups and venture capital firms in the United Kingdom, in the Middle East and in Africa. And in March this year, he published his book, which is called Future Money, with the subtitle FinTech, AI and Web3, which captures, and I quote, the past, present and future of money, told through the stories of entrepreneurs, investors and builders from London to Hong Kong via Bangalore, Cape Town, Lagos, Moscow, Singapore and many other points on the global map. So, ladies and gentlemen, please join me in offering a warm welcome to Ronit Ghose, who is joining us from Dubai. Good to have you with us, Ronit, and have a simple question for you. How do you see the evolution of finance over the next 20 years, and what will be its drivers? Over to you.
Thank you, Judith, for that kind introduction. And thank you, Luxembourg for Finance, for inviting me to speak at your event. It's an honor to be zooming in from Dubai, the United Arab Emirates, where I've been based for the last 8 years. I run a think tank for Citi called Future of Finance. It's what it says in the name. We analyze, think about, write about, and dive deep into where the world of money and finance is going. We do this based on a combination of desktop research, reading, but more importantly, meeting people and getting inside businesses. I've had the privilege of working in one of the world's largest financial institutions for over 25 years. I also sit on the advisory board of variety of universities, VC firms and startups in London, where I spent most of my career, in Dubai, in Africa, in Cape Town, Johannesburg, and also points further east in Asia. Part of the reason for moving to Dubai a few years ago was the shift in the center of gravity. Now, of course, London, where I spent most of my career, is still hugely important as a financial center, as a cultural center, and more. And Europe is sometimes underestimated in terms of the talent, creativity, and wealth in the continent. But there are huge challenges as well as Europe faces up to this amazing changing world we're in. And a lot of that change is being driven out of areas that used to be called emerging markets or the global south. Those terms really less and less relevant today. In many ways, you've heard the term and the concept leapfrogging. In many ways, these markets, be it Kenya, India, or more developed ones such as China, Singapore, and the UAE, have emerged when it comes to finance and technology. In many ways, they've leapt ahead. When I started my career in the 1990s in London, it was a very different world. People say finance hasn't changed. It has changed a lot. And just by spending a couple of minutes reflecting a little bit autobiographically on how finance has changed, it gives you an idea of maybe the change we've experienced, but also It's a foreshadowing of the change that maybe our children will be experiencing, but at a much faster speed than my career over the last 25, 30 years has experienced. One of my first value adds, one of my few value adds as a young analyst was I was in charge of calling the office. What do you mean, calling the office? So my boss, the managing director, and I would go to meetings, analyst presentations. I was a stock market analyst for many years. We'd come out of the meeting. It was in person. It wasn't in Zoom. It would be in a big ballroom or boardroom in London. We'd come out of the meeting and John would call the office. We'd find a payphone and he would shout down the phone, usually some very insightful, brilliant comments about what had just taken place in the meeting, but we'd do it on a payphone. This is the mid-1990s. By now, most people had already got a Nokia or Ericsson mobile phone, the old-fashioned USSD mobile phones. My first job was to go and buy one, dial the office, call the trading floor, and hand the phone. Obviously not this is a smartphone. Hand the phone to John. I would literally hand the phone to John and he would call. He would do his models, his very complicated financial models on a scientific calculator. I would spend a lot of time typing in numbers from central bank documents into a spreadsheet. These would be trends in the UK banking industry. And I would put it into a spreadsheet, and then John would email it out to clients because email was beginning to get used in the mid-1990s. Before that, we were on faxes. It's unthinkable 10, 15 years later that clients would pay for us to email them spreadsheets based on publicly available data that they could download from the desktop computer. And now they can download from their phones. We've transformed the way we do finance. We've gone from voice. Trading floors used to be voice-driven. Even when we moved off the stock market trading floor onto the bank trading floor, these are voice brokers shouting down telephones to electronic trading, particularly in equities and now in bonds as well. The world has changed in the last 25 years. It's going to change further. Artificial intelligence, and particularly Gen AI right now, which is a wraparound AI, DLT and blockchain, other financial market infrastructure changes. These are all going to rapidly change the world. And I'll come back to that in my comments in a little while. But what's driving this change? What's driving this change? Banks have always been, in finance and money, have always been at the forefront of technology. In many ways, money is a combination of a societal, almost a quasi-religious idea and a technological form factor. How does money start? So in the classic idea of money, the classic sort of almost children's storybook, you start with barter. In reality, anthropologists and historians now believe that it started with gifting or reciprocity more than barter. I do a favor for you. You have a mental note of that, or a physical note. You do a favor back. You trade barter. It's not barter. You don't trade goods. You trade obligations. In a way, debt. You're trading debt. The first surviving, or one of the first surviving pieces of writing in the world, several thousand years old, is a debt contract. It's not a love poem. It's not a piece of religious text. It's a debt contract. Some people might think that's a bit sad, but there we are. It's one of the first surviving pieces of writing from what we now call the Middle East, but back then was the cradle of civilization, urban civilization. Technology in more recent times, I gave you the mobile phone analogy. The technology has evolved in so many different ways. What does digital mean? And what does fintech mean? A lot of people talk about digital finance and fintech. There are a lot of definitions. In simple words, simple terms, it's financial technology. I sit on the advisory board of a Center for Financial Technology of a business school at a university in London. The words financial technology appear in their title. And you could argue that financial technology or fintech goes back to the 60s. hardware, mainframe computers start emerging in financial institutions, government departments, NASA, the space agency, late 50s, early 60s. Banks like my own bank, American banks, British banks, and French banks lead the way in the late 50s, early 60s in adopting mainframe technology. Before that, banks and branches, very decentralized. They literally run on local ledgers. Over the 70s and particularly 80s, you get centralization. And then in the 90s and the 2000s, you get hyper-centralization. You get global centralization. So you get organizations that are run out of London or Paris or New York with harmonized rules, harmonized standards, partly driven by regulation, driven by regulators' desire to have rules applying everywhere. Now, regulation is a positive, but it has to be managed carefully. Regulation is a positive because without regulation, you wouldn't have the trust factor that is essential to banking. What makes a bank different to a non-bank? So a bank has the ability to literally create money. A bank is where we keep our money safe. It's usually the institution where we transfer money, though payments, particularly consumer to consumer or C2C, and consumer to business are increasingly done by fintechs, not by banks. But B2B and to some extent B2C still remains very much a bank thing. So banks are where you do payments. Will that change in the future? Will our behavior, consumer to consumer and consumer to business, go into the rest of moving money? And what does that mean when we decouple payments from a bank? Will I keep my deposits in a bank? The raw material of finance, the raw material of banks is those sticky deposits. What will happen to those deposits? Will I use the bank for borrowing? Will the banks be the main lender? Increasingly in markets like the US, not just debt capital markets, which have existed for decades, but now what's called private credit has been growing. So alternative asset managers provide finance, and this is a trend that's spreading into Europe as well. Will banks be the main provider of credit? Will we go to banks for savings? Just the sheer nature of the bank is changing. But the reason we trust banks is that they're regulated entities. The government has put a stamp, someone has put a stamp on it to say, Joe Public, this is safe. You can use this. Deposit insurance is obviously a manifestation of this. And so regulation serves many purposes, including to provide a stamp of trust for consumers and non-professional users. At the same time, regulators, like most civil servants, and dare I say, many managers in banks and other large institutions, don't tend to naturally be creators or innovators. There's this idea or dichotomy between founders and entrepreneurs and managers and bureaucrats. Most people work at a large institution, be it a government institution or a financial institution, tend to be in the manager bureaucrat bucket. Now, they are very good at running things at scale. They're very good at getting things often done at scale. They're less good at starting new things. It's a different mindset. It's a different mentality to start new things. What does it mean to be an entrepreneur? That is a topic I discuss in my book. I think Judith and others will refer to this. It's called Future Money. We interview and talk about the crazy ones, the slightly mad ones, the ones who help build things around the world. In the book, I talk about a friend of mine here in Dubai who's working in an elite prestige job in New York. Just before COVID, decides he is going to throw it all in, throw in his comfortable life and well-paid life in New York, working for a big American bank, an investment bank, running money, running a global emerging market portfolio, to go back to his wife's home country, Pakistan, to build a fintech. In a country there's hardly any fintechs, in a country where there's not much VC funding, in a country where most people don't have bank accounts and very few women have bank accounts. It takes a level of craziness combined with competence to want to build something where no one has really done it before. And those are the stories that I loved exploring in my book, but also those are the stories of people who build new things. Now, at the start of this conversation, at the start of this speech, I mentioned how there are challenges that Europe faces, and building new things is one of them. There was a time, there still is in recent decades, lots of evidence of this, that Europeans build lots of amazing things. The World Wide Web, WWW, created in Geneva, CERN, by Brits and Europeans. Linux, open source software. Lots of interesting things have been built. The challenge for Europe is that they tend to get scaled in the US. And now we're running in, and have been for the last couple of years, into a world of AI, DLT, blockchain. How does that reshape the world? There'll be lots of really interesting AI engineers and startups, I'm sure, in Paris and London, elsewhere. But will they get scaled in Europe? AI will change how we do our work. It'll commoditize, in many ways, intelligence and advice. I don't believe it replaces humans, and we don't have time on this speech presentation, sadly, to get into more details on AI. AI in 2024 and 2025 will be used by big enterprises to revolutionize how we do information management, software development, software coding. There'll be big productivity boosts probably in 25, 26 in those areas. But will it lead to new business models? Will those new business models be created in the traditional finance sector by incumbents? And it takes me back, as maybe my final closing comments, to the idea of innovation in general. I'm sure you've heard this idea, this analogy. What is innovation? I have a horse and a cart. And the incrementalist view of innovation is I make that horse faster or fitter. Many incumbent firms, banks and others will look at AI with that lens. Let's make that horse fitter or faster. Effectively, AI will give me a second horse or a third horse. True innovation is to think, do I need the horse? And the question I leave you with is, how many incumbent banks are thinking about, whether it's in Europe or elsewhere, do I need the horse? Is it the combustion engine that replaces the horse and eventually an EV? And what is that in finance? And who is thinking those thoughts? Are those thoughts being thought in Hangzhou, in Shenzhen, in Bangalore, in Dubai, in Abu Dhabi, or in Luxembourg, or in Switzerland, or in France, or in the UK? It's a super interesting time to be in finance. The speed of change due to technology such as AI, blockchain, and others make this a fascinating time to be watching change. How do we stay relevant as institutions, but also as individuals? Big, big questions. One piece of advice I leave you with is stay open. And that hopefully is Luxembourg and Europe's big advantage. Being open to new ideas, being open to change. Because if you're not, you're going to fall behind. Thank you so much for inviting me to speak to you today. I hope this event is useful, and you can contact me, Google me, look me up on social media. I'm pretty open. Look forward to starting the conversation and continuing the conversation further. Thank you so much for having me.
Thank you very much, Ronit Ghose there from Dubai, with an invitation and probably a theme that will reverberate throughout the conversations today, to stay open-minded and also be mindful of the speed of innovation and not being left behind. Now, Ronit just mentioned payments. and the change within payments as a crucial building block for the transformation we're witnessing, as Ronit has just described. So digital payments are actually growing exponentially as consumers and businesses are moving away from coin and paper, certainly prompted in Europe by the surge in online business and online shopping due to the pandemic, and afterwards it continued. So last year, Capgemini predicted in its global payments report that by 2027, digital payment methods will account for about 30% of all non-cash transactions. And the most recent report, just published in September, puts global non-cash transactions at $1.4 trillion. And this figure, the report goes on to say, is likely to double in just 4 years. And the share of digital payments is going to increase alongside. Now, meanwhile, central banks are trying to keep up. A report by the Bank of International Settlements just published in June shows, and this is down to a survey done last year in 2023, that some 94% of central banks surveyed are exploring a central bank digital currency and are at different stages in their work on retail and or wholesale CBDC. And just to name the ECB as an example, we know that since May this year, the ECB has been conducting trials using DLT for central bank settlement with the first wave of participants in the Eurozone. So for more on these payment trends, I have the pleasure to introduce our first conversation and the moderator for this conversation, Emilie Allaert. Emilie leads the Luxembourg Blockchain Lab since 2022, after serving as head of operations and projects at the Luxembourg House of FinTech, and after serving in previous roles at KPMG, at JP Morgan Asset Management and Alpha FMC. She also co-chairs Alfie's working group on blockchain and cryptocurrencies, and she runs her own company called Digital Minds, which aims to help SMEs find the AI tools that serve their needs. And I love her tagline, which is, technology is not something we should be afraid of, but we should have the keys to understand it and embrace it. And in this spirit, she also passes on her experience to the next generation, teaching digital innovation and DLT at the University of Luxembourg. So warm welcome to you, Emilie, and I hand it over to you and your guest.
Thank you, Judith, for this nice introduction, and it's an honor to welcome Romaeus Ram, the CEO and founder of Finality International since 2019 and the consortium executive of Utility Settlement Coin, its research-based front runner since 2017. With more than 22 years experience in traditional banking, financial institutions have definitely no secret for you. You have experienced firsthand the evolution and the importance of digitalization in the processes. As digital transformation reshapes everyday life, it's also revolutionizing the payment systems, from cryptocurrencies to stablecoins or CBDCs, digital form of a fiat currency. The financial world is at crossroads. These innovations, built on distributed ledger technology or DLT, challenge the dominance of cash and bank deposits, reigniting debates about public trust and private sector efficiency in payments. So let's dive into this discussion with Romaeus. Finality has been in development for several years now. So next to explaining us what Finality is doing, could you elaborate on your mission and how it's evolved in response to the regulatory and rapidly changing financial landscape?
Of course. So first of all, it's a pleasure to be here. Thank you very much, Emilie, for hosting this session. I'm very honored to be asked. So I guess the question's really about our development over the last several years and our mission and how we've responded to the changing financial landscape. The mission has largely been the same since we started as a research project, as you mentioned, back in 2017. And the idea then was essentially a host of large financial institutions, mainly banks, wanted to essentially find a way to harness what they were observing happening in the public blockchain space to make better all of their settlement processes. So at that time, the idea was really around lowering costs, operational costs, and as we discovered later, lowering the need for the financial costs associated with settlement. Essentially, we wanted to bring the innovation of the DeFi space to the traditional space. Over the years, we've basically developed a kind of thesis that public blockchain could, in fact, become a platform for general purpose financial transactions, i.e., retail may use it for one or other different use cases. But of course, well, not of course, but we also believe that for the kind of wholesale financial market, public blockchain probably won't be, at least in the near term, so near term being 10 to 15 years, won't be a suitable mechanism. So we also believe that finality might provide kind of a regulated bridge between the old worlds and the new worlds that are evolving.
Nice. So you mentioned the significant research part. What are the key problems you're addressing? What you're actually observed, and why are they critical in the context of global payments?
Yeah. So when we first started on this, the idea was that banks have quite expensive set of operational processes designed to ensure that everything that they transact in gets settled on time and efficiently and so on. But there's a lot of wasted both operational and financial resource around that, because everyone is holding their data on different ledgers, and they all need to reconcile at various points in time, and they also need to transport funding from one place to another in order to make sure that they have sufficient funds available to make the settlements good. We believed with this finality, and before that, the utility settlement coin project, as you mentioned, that we could essentially reduce a lot of the operational costs, and as it turned out, even more importantly, reduce a lot of the financial risks involved in settlement by essentially ensuring that people could meet effectively bilaterally, and use the same pool of money to settle all the different assets that they have. So I guess what I'm trying to say is we envisaged a kind of new settlement model that lowered the need for various intermediate settlement venues for settlement. Let me give you an example to kind of make that more real. Currently, when you trade some form of securities, you need to go to that securities venue in order to settle it. So as a bank, you'll essentially need to deliver some of your liquidity to that settlement value ahead of time, and then they will ensure that you get delivery versus payment, so that the securities settle at the same time as the funding exchanges hands, and then after that they will give you the money back. What that means is your liquidity is lost for some period of time to you to use for other purposes. The idea that we had was basically, can we allow people to operate out of a single pool of liquidity where they could settle instantly in either DVP or PVP in the case of foreign exchange, all of their different transactions. Okay, so I explained that I understand that there are a lot of various elements entering into this global payment thing. The world of fintech is constantly submerged with buzzword, and right now it's all about CBDCs. Judith mentioned it. There are a lot in the space that is going on. All the G20 countries have currently a project on CBDC. So why is it so important now? Why are we looking to translate the fiat currency into the digital space? And what is the main difference with a stable coin? Yeah, I mean, there's quite a few questions in your question, so let me try and take them one at a time. So as you rightly mentioned, there's a lot of interest in central bank digital currencies. I think there was in the introduction, there was a quote about how many central banks are looking at central bank digital currency. There's basically two forms of central bank digital currency. One is a general purpose, I guess is the word that's used, central bank digital currency, and that's meant for kind of retail and small enterprises making payments. The reason there's been a lot of interest in that over the last 4 or 5 years is back in 2019, you may remember Facebook via the Libra project introduced the concept of having a stable coin that would go to everyone basically. And of course, the central banks were concerned that while this could be a good thing from the perspective of ensuring that the economies work well and people got convenience and so on, it may not be such a good thing from the perspective of trust. So the central banks were worried about trust moving to some sort of stable coin or coin that didn't have the backing of the state and the trust associated with it, and therefore didn't ensure the stability of the economic system. So there was a lot of work around kind of general purpose CBDC since then. In terms of wholesale CBDC, so actually the thing that I'm working on is essentially a private sector answer to wholesale central bank digital currency. So we are, this is the purpose of finality. The central banks had originally written a number of papers back in 2017-18 that kind of dismissed the need for a wholesale CBDC. And the rationale actually was pretty reasonable. The rationale was in wholesale, it's essentially banks settling with one another. And of course, all the banks are connected bilaterally via the existing central bank real-time gross settlement system, so Target in Europe. So why would there be a need for anything else? Over the course of the last few years, we amongst others have kind of shown that there is a need for something that mimics the qualities of CBDC, and the reasons are a combination of functionality. How do you achieve this single pool of liquidity that I talked about earlier, where you can settle from all your different assets from one to the other? And the second one was actually, how do you link up payment systems across the globe? It's not so easy if you don't have some sort of CBDCs that are somehow joined together. There's a lot of investigative work still going on around CBDCs. So the central banks, I think, are still somewhat in research mode, but they've kind of come to the conclusion that possibly they need to bring their, all the benefits of CBDC to the wholesale market. I was going to say a second part of the question that you asked is, what's the difference between CBDC and stablecoins? So maybe I can just say for 1 second something about that. So as I said, the CBDC conversation really rose from Facebook Libra and the stablecoin proposition. Stablecoins historically have been some sort of token that is backed by something else. So historically, it's been backed by, the safer ones have been backed by, for example, US Treasuries or other kinds of safe bonds. Some of them being backed by bank accounts in different banks. But there's been a spectrum of them. Some other stable coins have been backed by other cryptocurrencies. And in fact, there have even been stable coins that are basically kind of algorithmic contracts. But in essence, they're all theoretically backed by something. And whether you believe they're stable or not depends on how much you believe in the backing. This is quite different from a CBDC, because a CBDC is essentially a liability of the central bank. So the central bank has the obligation to make good on whatever is issued under a CBDC.
Okay. One point you mentioned is the fact that various central banks are actually figuring it out and maybe enter the space of CBDCs. How do you see the interoperability working? Because with the number of banks, CBDCs will be multiples. So I'm curious to know how the technology that you're building addresses this need for seamless interactions between the various systems.
Thank you. So this is actually one of the reasons that we believe in kind of the finality proposition. So pretty clearly, the central banks could easily, within their own jurisdictions, build some form of CBDC. the big issue for them is how are they going to interoperate with all the securities venues that are going to hopefully exist in the future. So that's at both kind of a technical level, which would be a reasonably easy problem to sort out, but also at a kind of legal level. So what do I mean by at a legal level? You need to ensure that the rule books for both the CBDC and the security settlement system guarantee settlement finality when you do delivery versus payment. And then, of course, you have the issue of cross-jurisdictional interactions. How are the central banks going to basically ensure that all the same things, both the technical and the legal interaction, work across all of those jurisdictions? And in fact, how are they going to provide governance when they're moving across different jurisdictions? Like, who is going to be the operator of such a system? Is it going to be central bank A or central bank B? We believe that it's easier for the private sector to solve because we're one entity, and then we just need to get approved by all of the different central banks. And so, but we believe we have methodologies to cope with all of those different problems: the technology problem, the legal problem through synchronized rulebooks, and indeed the governance problem.
And speaking of regulation, what about MiCA? Is it something that is helping in the space of digital payments? How does it compare with other jurisdictions? Is it a good thing for Europe? Do you see something better outside of Europe? That's a question I'm curious to hear about from Finality.
So one of the kind of key realizations for Finality was that we didn't need any rule changes or any changes in regulation or law, in fact. So our key insight was basically there are already a number of regulations in each jurisdiction. There's settlement finality, there are laws and regulations around payment systems, etc. So we actually went the route of becoming a regulated payment system, which means that we don't actually need MiCA in order to operate. In order to operate in the way that we are, what you need to do, it's still a very high bar. You need to become a regulated payment system. You need to meet all of the standards associated with that, et cetera, et cetera. But it's a well-known, well-trodden path to go. And really the difference between us and any other payment system is essentially the database. So our database is a blockchain. Other people have, standard databases like Oracle databases or whichever company you care to think of, but it could easily be a spreadsheet or something like that. But there's no reason why the regulation should change other than, you obviously need to guarantee operational resilience and all of those types of things. There's no reason the regulation should be any different for different types of payment systems. The rules are kind of principle based, and you need to meet those. Rules. So going back to your question about MiCA and payments, it hasn't really impacted us from a payments perspective. I believe MiCA does deal with the issue of stablecoins, but because that's a different kind of methodology. And I think the good thing about MiCA is it will allow some form of experimentation to find the governance frameworks and so on that will ultimately work. So I guess that's a long-winded answer to saying you don't have to go the MiCA route. You can go through existing regulation, but MiCA and other regulations like it seem to be pretty useful for people that want to experiment with something that's outside of the pre-existing regulatory framework.
That's nice. A question I have is, we mentioned quite a lot finality. I would like to have a more global view on how DLT is actually simplifying global payments. That's the title of our discussion, and I'm curious to know what is your opinion on that, how the technology is actually helping us in this field.
Yeah, so I'd actually start up with a quite controversial statement, and the controversial statement is, it's not really so much about the technology, it's actually much more about the implied kind of model change. And when I say model change, what I mean is kind of reducing the need for lots of intermediation. So right now, I kind of described this at the beginning, there is a lot of need for balance sheet intermediation in order to settle different transactions. If you can settle directly with the person that you transact with, and that's kind of implied by how you see blockchain technology used in kind of public blockchain, then you start to lower, obviously, all the operational costs, but you actually also start to lower all of the financial costs associated with building up your balance sheet and so on, because you don't involve a third party in those types of things. Nice. So now the question comes, well, could you achieve this in some other way without using blockchain technology? And actually, I believe that you can achieve almost all of it using regular databases. So we've designed a kind of rule book that will allow this to happen. The synchronization of the rule books across the different jurisdictions or with different other assets can be done. It's not dependent on the underlying technology. And we've also sorted out the governance, which is also independent of the blockchain. So the model itself is not 100% dependent on the blockchain. However, we've chosen to use blockchain technology for kind of two and a half reasons. So the first reason is actually to do resilience. So when you build a payment system, if you're successful, lots of people will be using it and they become dependent on it. When you have a distributed ledger type system, you basically have almost automatically business continuity planning and all of this kind of recovery, et cetera, And as you can see from the public blockchain space, it's actually quite hard to hack. It's and so on. So this is not to say it's impossible, but it's substantially harder than it would be in normal systems. And you can do that for a much lower cost of the cost per unit resilience is much lower.
Thanks.
The second reason,
we're running a little bit out of time, okay. So let's do the second reason, and then we'll close this.
Okay. The second reason is actually to do with innovation. So blockchain is obviously protocol based, much like the internet. And so what you see is these things that people call smart contracts. And when you have smart contracts, it becomes easier to layer innovation on top of the underlying system. So think about the internet. There is an internet. And you can search it using Google, and everyone has their web pages. But different people add different things like Google Maps to the internet. But then other applications can use Google Maps. Like if you want to find a restaurant, you can find it inside of the restaurant app that will or Uber. The taxi company will allow you to kind of compose all of these different features. And so there's kind of a building block approach to innovation that can happen when you use blockchain. I'll stop there.
Okay. One last word to conclude this discussion. What would be your advice for financial institutions to maybe embrace technological change and to ensure they remain competitive in the landscape?
Yeah, so for me, I guess this starts off with, do you believe that all of this digital change is going to happen? I think at this point, many people would say that they believe it will eventually happen, but they don't know the time frame that it's going to happen in. And to know what's going to happen, you simply need to look at the internet. If you recall, the story of the internet was you could basically when you first could buy CDs, you could easily buy the compact disc online. You press a button and it was yours. But of course, it took like 7 days for the compact disc to come through the mail and for it to be delivered. When you really think about it, this is kind of what's happening in finance, right? Now there's all of this electronic trading. It's happened instantly around the globe and so on and so on. But it still takes, a few days for the money to move, the money or the security or the asset to move from one place to another. What the blockchain space in general has shown is you can actually shrink that time. And so the banks will need to think about how they're going to replumb for a world where trading is already instant. They can already do that. Settlement's instant, and your risk is going to be changing instantly. So how do all of your systems start to change, and your controls and your whole set of operational processes, etc. And I think for most of them, you've got to kind of get into the story now, because the answer to those questions, while it might not happen for a few years in totality, it's going to start impacting what you're doing today as the market starts to evolve. So for me, the main message is you should get involved now and start making the changes that you need to make, or definitely thinking about all the changes you need to make.
Well, thank you very much, Romaeus, for this insightful discussion. I now have the pleasure to give back the stage to Judith. Thank you very much and have a really nice day.
Thank you, Emilie, Allaert and Romaios Ram, with the tour de force on central bank digital currency and digital ledger technology. And again, Romaios echoed the advice from Ronit, get into the game now because we're moving at a very fast speed. And if you want to get an overview, an idea of the market of digital assets, you could look, for example, at the Financial Times Digital Asset Dashboard. It shows you a circulating value of the 500 largest digital assets of roundabout at the moment $2.3 trillion. But really, when you keep listening to these conversations of what Ronit and Romaios were talking about, for me, this is just a snapshot of a much larger story, and that is called asset tokenization. Now, think about it. Anything can be tokenized, which is, of course, the process of breaking up the value of an asset into digital tokens, and you can hold that token, you can sell it, it can be bought and traded on a blockchain network, as Romaios was just explaining. And you can tokenize anything: stocks, bonds, commodities, also real estate, copyright, a movie, even a bottle of whiskey or wine. Now, a research team at Boston Consulting Group describes the market of tokenized illiquid assets as a, and I quote, $16 trillion business opportunity by 2030. And that is their conservative forecast. The best case scenario is actually at $68 trillion. So our first panel session will now dive into the topic of how digital assets are reshaping capital markets. Our moderator for this session is someone who knows quite a lot about it, Steve Jacoby, here with us in the studio. He's a partner in the Luxembourg office of Clifford Chance and the regional managing partner for Continental Europe. He also co-heads the Luxembourg banking, finance and capital markets practice. And in particular, his focus is on financial regulatory matters, on fintech and also innovation. And allow me to add that Steve and his team have also been advising the European Investment Bank on some groundbreaking digital issuances, including last year its first ever digital climate awareness bond. So, warm welcome to you, Steve, and I hand it over to you and your panel.
Thank you, Judith, for the introduction to the panel on how digital assets are reshaping capital markets. And I have with me today Thilo Derenbach, who's the Head of Sales and Business Development Digital Security Services at Clearstream Banking, John O'Neill, the Global Head of Digital Asset Strategy at HSBC, Bazak Tobrak, the Executive Director, EMEA, Head of Coin Systems Onyx for JP Morgan, and Martin Watkins, CEO of the Montes Group. So what are we going to talk about today on this panel? First of all, a word about the concept of digital assets that we're going to talk about. We're going to focus mostly on digital financial instruments. So for those of you familiar with the European legal and regulatory environment, it's mostly the instruments that sit in the area of MiFID regulations, the pilot regime, etc., rather than the ones which, the digital assets which sit in the area of MiCA, which other panels are going to cover. So it's around tokenization with financial instrument-like characteristics, but it's also going to be about the infrastructure that is supporting those markets, so payment rails, cash tokens, etc. Obviously, these are not two worlds which are completely separate. There's quite a lot of overlap in terms of the innovation, in terms of the technology that is going to be used, particularly the DLT technology, and we'll also say a few words about that. So what we will cover is what the evolution was over the last 2 to 3 years, what we have learned from that, and where do we think we are going. And also, what is the wider benefit of this innovation? We have seen in the recent past a lot of discussions again around the Capital Markets Union and the EU project around that, the Draghi report and the need for financing for all of the elements that I mentioned therein, access to finance by SMEs, the first learnings that have been communicated on by the ECB around the ECB trials of in the context of wholesale CBDC, and generally questions around how do we achieve greater liquidity and easier and faster access to capital markets. So one of the questions that we're going to deal with today is whether digital assets are a potential answer to that. So let me turn to my panel now and to our first questions, which I'm going to start with John O'Neill from HSBC. John, what are the key elements of the evolution of the digital capital markets over the last few years, and particularly looking at digital asset issuance?
I think the key point we've seen over the last few years is this moving from what I would think of as an experimental subject to a real subject which is liquid and at scale. So HSBC and a number of other institutions in previous years have done fairly small digital asset issuances, which were in themselves challenging and interesting and engaging for the market. In those issuances a few years ago, what we were seeing was typically small numbers of investors investing in digital assets which were available through a fairly limited number of access routes, with resulting interesting but not very high levels of liquidity. I think what we've seen in the last couple of years, and particularly this year, is that the liquidity profile of digital assets really has stepped up by an order of magnitude. And we think that's really important because although digital assets can offer a lot of benefits, we believe, they're only really interesting for investors and traders if they have very similar liquidity profiles to conventional non-digital assets. So what we've seen over the course of this year, including some of the issuances we've done at HSBC, is increased liquidity profile, more activity in primary markets, a lot more secondary market activity, and even things like repo. So for me, the overall theme, particularly of this year, and the journey we're on, is increasing liquidity, increasing connectivity.
If I may, I'll complement to what John already mentioned. I'll start a little bit further in history, not too far back. But when we look at our financial industry, overall, it's come a long way when it comes to digitalization and perhaps tokenization, if we want to include that specifically. It's not been one of the first industries to really adopt digital capabilities, rather one of the last, if we look at the large industries. But it's come, as I said, a long way over the last few years. And to John's point, we've seen a lot of positive evolution in regards to market participants, market infrastructures, and the environment evolving. We've seen, I think, and Steve, you know this is, of course, very well from the Luxembourgish market. We've seen very good domestic, very comprehensive regulation being articulated in a number of countries, including Luxembourg, of course, or Germany, so with the Blockchain Act or the E-Securities Act, EWPG. So also here we've seen some really good development and creation of sound guardrails, if you like, also from a regulatory perspective. And as John here represents also HSBC Orion, we've seen a number of primarily, but digitization and tokenization platforms mature. One of them is what we have developed at Clearstream, or at the Deutsche Börse, the German Stock Exchange, which is D7, which compared to other platforms such as Orion focus on the digitization of securities, so the creation of an MP3, if you like, of an instrument, but not going the full mile yet of DLT usage. And if I may, more recently, just to add to that, I think on the regulatory front, as you rightly said, there's further good development with MiCA that's come into force. On the cash side, the ECB trials that you rightly mentioned are extremely important on this entire journey, and for the first time give us wholesale digital central bank money on chain as something we can trial and experiment with. And on the collateral side, we shouldn't forget that side. I think the aspect of ability to reuse tokenized or digitized securities is very important. There are a few solutions out there, such as HQLX, but others are coming. But there's still a long way to go, I think, Steve.
Thank you, Martin. Maybe you can also say a few words about the legal innovation that the operators are seeing.
Yep, certainly. And I think this stems from one of the main facilitating components is to have legal and regulatory certainty. In terms of looking across what we've seen in place, we start with France, and we saw the work that was put in with the SAPIN 2 Act and the blockchain ordinances. And that rather interestingly led to the creation of CSD called ID2S in France. Now, in its embryonic stages, it stayed with conventional securities and is no more because it didn't take the leap forward in terms of the evolution, but the laws were good. We've also seen across the rest of Germany, the German Securities Act, a good piece of legislation. But of course, there are components in there that require you to have a German custody bank who's actually authorized by BaFin and so on. So good steps forward, but certain elements in that which are limiting. We've seen from the Italians putting in legislation around the issuance of tokens, and we've seen from the Spanish, they put the new LMV laws in place. In addition to which, rather interestingly, the Spanish have put in place the startup law, which allows entrepreneurs trying to encourage a 12-month period inside a sandbox environment. But I'll come back to sandboxes in a moment. And we saw places like Liechtenstein doing well. But from a Montes perspective, we've picked Luxembourg because we've made a full-scope CSD application to the CSSF and BCL. We're still an applicant. But the blockchain laws 1, 2, and 3 allow us to do a vast amount of what we see is required in the market in terms of putting infrastructure in place. The ability to record the instruments, transfer, hold them, everything to the extent except cash on chain at the moment. So we see that as an important and in fact quite critical move forward on that. But we've selected that Luxembourg at the moment has the best legal framework and jurisdiction from a European Union point of view. But if I then look elsewhere, we still keep a very close watching eye on what's happening in Singapore and Hong Kong, and there's some trading off and on there. Regarding the sandboxes, we've seen about the EU pilot regime, and congratulations to CSD Prague in getting authorization this week, which is great. Similarly, from a Montes perspective, we've said that we will apply to the Bank of England's sandbox because that allows us with a full scope CSD lift across, so taking all the capability that we're building for Luxembourg, moving and copying that into a UK environment so that we can have a like-for-like link. We actually then can move in a UK environment to do cash on chain. And we think cash on chain is really pivotal behind getting the adoption and moving forward. So there's some of the characteristics that we see really critical at the moment.
Thank you. Well, I think that's the, Barzak, maybe I can hand over to you speaking about cash on chain and more generally payment rails and the role of digital assets in settlement.
Sure, thanks, Steve. Indeed, as Martin mentioned, we see cash on chain as a critical component of enabling assets on chain and the settlement and finality. So, as Martin noted, right now we do not have central bank money on chain to support these activities. ECB is working on a number of solutions which are trigger-based solution, full DLT solution, all with the purpose of understanding the benefits of cash on chain and working towards a wholesale, longer-term vision and solution. But in the meantime, from a commercial bank money perspective, I think what we have done within JP Morgan is we have enabled commercial bank money on chain through our JPM Coin solution, which is a blockchain deposit account. So we are essentially recording deposit claims on DLT. Everything else is very much the same in terms of depository framework and reporting and the way that clients interact with their deposits. But what this does and what this gives us within JP Morgan, and also we've started enabling this for external platforms recently as well, that you can enable interesting business models like intraday repo applications where you can identify precise timing of a repo trade through the use of cash on chain tokens, tokenized treasury bills versus cash on chain, you can create these new ways of providing secured financing on chain. So we see that as a very critical way of showing, a very good example of showing how cash on chain enables these developments. And recently, we've done some really interesting work. Again, very much inspired at the back of the ECB trials as well. We worked with a Swipe platform based in Germany to enable commercial paper settlements through JPM coin for Siemens. So I think these are very timely developments where we show that how different platforms can collaborate together to use almost different components of each platform, and in the end, basically enable a more efficient way of settlement and digital asset ecosystem. So, hopefully we'll see more of these going forward.
Well, we're going to come back on the interconnection of platforms, which I think is a really, really interesting topic. But before we do that, and looking forward, I would like the panel to sort of spend a few minutes to talk about what you see as the opportunities of a full-scale adoption of digital securities in a digital environment. So we'll look at issuers, we'll look at investors, including the topic of collateral mobility that we already introduced, payments again, and then I think markets more generally, if anybody wants to comment on that. So John, can I start with you? What was the benefit for issuers of this these digital assets in capital markets?
I think there's a number of benefits, but probably the outstanding one, which we hear from issuers a lot, is more rapid settlement finality. So shorter settlement time of digital assets and more precise settlement time of digital assets compared to conventional assets is something which is very attractive to issuers. Perhaps I can illustrate that by some of the digital bonds that we've done in Hong Kong. So we did 4 digital government bonds on our HSBC Orion platform in Hong Kong towards the start of this year. And in that case, conventionally, Hong Kong government bonds are settled at a cycle of T+5. It takes 5 days to settle normally. By digitizing these bonds on HSBC Orion and offering to the market in a primary, we could bring that settlement time down to T+1. So that's a really material shortening of the settlement cycle for the Hong Kong government. And also, in addition to that, we could get rid of what's called a global certificate in Hong Kong, which is actually a physical paper-based copy of the bond, which is always associated with conventional issuances. So we were able to entirely do away with that as part of the overall digitization of this product. So what we see there is shorter settlement times. We see, as I said earlier, a lot of interest and liquidity in the primary market because people are always interested in owning this kind of high quality debt. And by the way, I always emphasize that
I think
which do the best possible job on digital asset markets. It'll always be the I'm sorry?
Sorry, we lost you there for a second, John. Please continue. You're back.
Steve?
No, we lost you for a second, but okay, come back.
Yeah, no problem. I hope you can hear me clearly. But there'll always be interest in high quality debt and other instruments if they're expressed in a digital form. But I always emphasize that it's the underlying instruments rather than the format which is most attractive to investors. But these digital assets, which are traditional financial market instruments in a new form, if they can add benefits such as shorter settlement cycles while still maintain high levels of liquidity, that tends to be very attractive to investors.
So, Thilo and Martin, what benefits you see from an investor's perspective?
Yeah, perhaps I'll just quickly pick that up and just to add to what John already said. I think that the speed, I think, is the word that we all want to refer to in this context. And the speed is actually beneficial, of course, to the issuer, but of course, on the flip side, also to the investor. Speed of issuance, speed of settlement, speed of finality, reaching finality, also from a corporate investor's perspective, issuer's perspective, apologies, the speed at which one can generate liquidity for the organization, the speed and the ability to reach new business opportunities, but also reach new distribution channels and reach new investors via the infrastructures that are being offered are extremely important. I like to, and I'll just make this little example or comparison. I remember, and some of you might remember, the electronification of the stock exchanges back in the late 90s, early 2000s. And when I was younger, I was able to invest into a stock in Germany at some midday auction once a day, where I could throw my order in, it would disappear, someone would price it, and if I was lucky, I would get a piece of stock back at a certain price. Nowadays, it's 24/7 trading, instant trading. We have high-frequency traders trading not in seconds, but million nanoseconds. So all of these things have evolved thanks to the electronification of stock exchanges. And I think we will see something similar benefiting both in issuers, but also the investor side when we move to the digital or even the tokenization of securities and processing them either on traditional modern technology or on blockchain technology.
And if I might pick up a couple of additional points on that, because we see a lot of work being done at the moment in tokenizing money market funds and so on, looking at programmable money market instruments, obviously short period of time, so you can see the whole life cycle actually going through. But we're also seeing the move to 24/7 ETF issue and redemption. The laws are not yet in place to support the full 24/7, but the concept, technically you can do it, the technology will allow you, and also the financial innovation to look at ways in which you can certainly move forward. But I think the key things that we see as the main opportunities coming forward are, first of all, major cost reductions. That does one of two things. One is it allows the financial institutions to offer a lower cost service to their existing clients. The other thing is to actually open up markets which today are uneconomic. So that we've seen a number of examples where we're working with globally systemic banks, looking at the type of cost savings we can make on the post-trade services. And it's in the order of magnitude of 45 to 60% savings using the numbers from the banks themselves. And we use that because we're looking at the full life cycle of digital securities, not just the issuance, but all the way through to settlement and so on. And we think that's really quite fundamental because that brings major benefits. We look as our example, the work that was done by Apex with Hamilton Lane, with Signum, and with the CSSF here in Luxembourg to create a fund where the subscription wasn't $1 million. The subscription rate was $1,000. Or €1,000. So a major difference, and you get access to those those inaccessible sources of funds. You build up additional fund investors, so there's a greater benefit for them, as well as still maintaining the quality of the top end of the instrument.
So looking at all of these opportunities, let's look at what is needed for this reshaping to continue its progress and to make sure that challenges are overcome and the right levers are being used. So Barsy already mentioned the interconnection of platforms. Let me turn to John and Thilo to maybe talk about what they see in this respect.
John, would you like to? Oh, I can start, and then John can complement, as I'm coming from the traditional world and with Ryan from the modern world. I think something that we've expressed, DTCC, Euroclear, and ourselves had expressed in a white paper that we issued last year, was that there's still a lot of standardization missing and interoperability missing and reuse possibilities missing for these digital securities. Why standardization and interoperability and reuse are important? Primarily because they drive the mobility of an instrument, they drive the liquidity in an instrument, and they also allow for a wider investor reach. We realize and we observe in the market that at the moment there are many good technical solutions, but I would call them still island solutions with limited liquidity, limited investor reach, limited instrument scopes in parts, but good quality technology that we need to connect and create that interoperability to have a mobile instrument flow across infrastructures with a wide range of investors being able to reach those. And I think one of the basic things that we need for that, this is again something we articulated in this white paper, is a certain level of standardization that will make it easier for infrastructures to connect, such as ourselves, to modern infrastructures such as John, yours, Orion, or to others, of course, that exist already in the market. And these standards are important to create a relatively easy environment to establish these. And I think we will see more standardization in the coming 12 months. We will see increased interoperability, I think, as well. And all of this will create the things we need: mobility, liquidity, and investor reach.
Yeah, thanks, Thilo. Totally agree with all those points you made there, and I can add more to that. So I think interoperability is a word that gets thrown around a lot in these discussions, and sometimes we almost lose track of why interoperability is interesting and important. The reason it's an interesting concept is that although we may not think of this in conventional markets that we use every day, like Clearstream or like our colleagues at JP Morgan or our other financial institutions, there's quite a deep web of interconnectivity already in place via custodians, via correspondent banks, via FMIs like Clearstream. And what we're doing really when we're moving to this new digital asset ecosystem is we're not entirely recreating that in parallel. I think that's important. If we tried to recreate it in parallel, there would be massive costs for us investors, and we wouldn't really have any convincing adoption pathway. What we're doing instead is upgrading market infrastructure, and platforms like our platform, HSBC Orion, we hope are part of that overall story. But in order to be a significant player in these new markets are always nodes. They're always connections of liquidity, and HSBC certainly aims to be a significant node in this new world. And so therefore, if you think of it that way, it's completely in our interest to connect to many, many different platforms, as many as our potential users and investors want to connect to. And that includes other banks, but it also includes CSDs. And we've had some good examples of that already. In Hong Kong, where I am right now, we've connected our Orion platform into the CMU, which is the CSD in Hong Kong, via a very close integration. And the benefit of that is very real to investors. So often for digital assets, people will talk about liquidity premiums. What they mean there is how much less liquid digital assets are than conventional assets.
So, Barsy, let me turn to you. How do we achieve this liquidity? And Martin as well, please come in as well. Is there a need to access regulated markets? Is it a question of the issuance size? Is it acceptance beyond Europe, where this phenomenon, I mean, John mentioned obviously Hong Kong, but is it a global acceptance that is required? Barsy, do you want to go first?
Sure. And I'll come at this question from a payments perspective still. And I think to the point made earlier as well, looking at the full end-to-end cycle of a financial instrument, financial settlement process, it's important to identify that sometimes when you talk about settlements and payments, we talk about primary issuance and perhaps use of central bank accounts, but we also know that not everyone has access to central bank accounts, and we also know that in order to have a global reach, oftentimes the liquidity is coming from another currency, another location. So to that point, making sure we enable strong links of commercial bank money in various currencies with central bank money is quite important. And I think when we have those strong linkages, then we have a fuller adoption of these newer instruments. And we see that very much supporting also business models toward creating composable functions of digital assets. So I think we all agree that the value that we will see from having digital assets online is when we create these utility between assets, the portability of assets across different applications, different use cases, and making sure we time them so that they happen at the back of each other in the way that we intended to do. So we create these programmable functions, and we're not, for example, pre-funding accounts just in case a trade happens, but just in time for a trade taking place. So I think all of these functions enabled by commercial bank money on chain and with strong linkages with central bank money will help us get towards that goal.
Tim?
And I think if I can build on that, I think from Barsyk's point, for digital securities to be able to achieve HQLA is really important across the whole market. And that's not just in one jurisdiction, one domain and so on. It's a more broader element. And that's why from our side, we very much support and see this as a key move forward. However, one of the interesting things is that financial markets, the global centers for digital securities, will be determined by the legislation and the jurisdictions that are in place. It is highly likely those will predominantly be the existing global financial centers for conventional securities, but it's not a given. So very much as in any transformation, there are openings for other jurisdictions to change the status quo. I think a couple of the other points around liquidity and what comes on there. One is from our side, we see very much the importance of having no dormant cash. So if you've got investors who are investing in funds and so on, that cash is only taken at the moment it's then earning a return for that investor for that fund. We've heard from John about the movement of the green bonds in Hong Kong from a 5-day settlement right forward. These are big steps forward, and what we see that doing is actually creating more velocity for collateral and velocity for cash. And that's actually why we, from the formation of the ECB's New Technology Working Group, Contact Group, we've actually been participating in that with the intention that when we get our designation as a securities settlement system and as a CSD, we would very much envisage that we'd be able to offer our European Union clients the ability to settle in central bank money, fiat, through Target 2, as well as wholesale CBDC on as a digital currency, the same element being central bank money. Similarly, where jurisdictions also allow elsewhere to actually look at being able to support commercial bank money, because we see euro, sterling, dollar and yen as being a major step forward in terms of how commercial bank money is more accepted for settlement through CSDs.
So we mentioned already the ECB, we mentioned the legislator, the regulators a few times. Can we take a quick look at what you expect the public authorities to do going forward to support this evolution? Don't know who wants to start. John, maybe?
I think, as others have said, the key to unlocking the power of digital asset markets and launching in different jurisdictions is nearly always law and regulation. And I think that's the principal thing that public authorities bring to bear. The technology for this subject is very important, but it's not just a technology subject. As was said earlier, often the legal innovation is as significant as the technological innovation. And therefore, marrying law and regulation with new technology platforms, we found that worked brilliantly in Luxembourg. It also worked well in Hong Kong, given the example that I mentioned earlier. And we think locations like Luxembourg, which have really led the thinking in terms of digital asset law and regulation, have a very good future on this subject. So that's, for me, is the takeaway point for public authorities.
I think if I can pick up on that as well, I think one of the key aspects that we see here is the ability to aggregate the conventional securities with the digital securities, and therefore the ability both for the legislation and the regulation to allow the two to coexist. The reality is we're already positioning with a proposition that enables us to do that here in Luxembourg, and we're putting the same proposition into the United Kingdom. From Luxembourg, it's the whole of the European Union member states. From the UK, we see it as a specific market, but we're looking elsewhere as well. And we think that's where the regulators and the legislators really start to come into their own, because they're starting to be the forward thinkers of what's an acceptable level of challenge, of new thinking, to markets which are so systemically important, they can't afford anything to go wrong.
Thilo?
Yeah, just to add to this, there are two things that I'll simplify a little bit, but two things that are really important for the market where regulators and also the central banks can support. One is, I would say, the two U's, usability and USP. We need real ease of use and access to these infrastructures, so keeping costs of adoption for all the existing market participants comparably low when we want them to move into the infrastructure. So good, solid regulation is important, but over-regulation would not be helpful, would possibly be harmful and delay the migrations. Central banks like the ECB proposing things like the ECB trials and extending those over time, not only through the trial period, but making them a more permanent sort of solution relatively quickly, I think would be extremely important. So that's that usability aspect. And the other one is USP. It's less related to the regulators themselves and what they can do, but we need to find more USPs in the new technology, because we don't want to push the market participants in the new technology for the sake of using a new tech. We want them to move to the new technology because they then can do more, better things on this platform than in previous environments. Martin mentioned the cost saving, which is one aspect of that, but it needs to scale, because saving 60% on $5 doesn't get you far. This needs to scale to the thousands, to the 100,000, to the millions of transactions to add up to a meaningful business case. So these two things, usability and USP, are important, and in parts the regulators, but also our domestic or the European Central Bank, for example, can contribute to that positive development.
So that leads perfectly, I think, into our last question, which is looking at the trends, and I think you have already identified a few through this panel. And let me maybe start with Berger. What are the trends that you see for the continuation of this reshaping, particularly from the payments and the settlement rails?
Sure. I would add that the cross-border interactions will continue to be important to enable payment rails for financial markets and to support cross-border financial settlements as well. I think from that perspective, correspondent banking arrangements that we have today already, and the two-tier money model that we currently have with commercial banking and central bank money will continue, and they will just be reformed in this digital space. And to support that transformation, it will be very important for central banks across markets to continue to work together across the initiative, so that we continue to have a harmonized approach as much as possible going forward.
Martin, your views?
I think there's a couple of things. I think, first of all, I think the comments that were made about harmonization and standardization are really critical. I do draw reference to the fact that there are still some very major CSDs who have proprietary interfaces. They're not using all the 15022, 20022 standards and so on. So we sort of see that there'll be more progress made there, but actually those CSDs might get left behind or find themselves in a weaker position. I think from our own perspective in gazing into the crystal ball is very much putting us, because I'm a couple of years older than Thilo, not many, but a couple. I go back to 1986 for the electronification of stock markets and see the movements that were happening there. I see in late 1990s, we had ECNs and ATSs in the US taking market share off the New York Stock Exchange and off NASDAQ. Out of the embryonics of that came one large giant called ICE. They moved from being electronic trading of petroleum to becoming the second biggest exchange group in the world in 20 to 25 years. But the key aspect in here is that there's very few disruptors coming in, and it's all about scale and that momentum and the opportunity. If we look at MiFID I when it came in, there were 45, 50 MTFs applying to the different regulators. But it was only Chi-X and BATS and Turquoise who started to make a way through. Turquoise acquired by the London Stock Exchange, BATS and Chi-X merged, and then acquired by Cboe. So to make the one additional exchange group from a European and a global market perspective. So we see very few disruptors coming in. We do see there being change, and we see that already from ourselves, where Archax, our parent company, is an MTF, a broker and a custodian for digital securities, and we're building Montis in a similar guise because there's going to be a small number who bridge the TradFi and the DeFi worlds together. So we see a small amount of change in terms of the actors, but we see a fundamental change in the roles that each performs.
Thilo?
Picking up on that last sentence, we will CSDs or market infrastructures in the way we've seen them over the last decades. Probably that will change. There will be some that might be left behind if they don't adapt and adopt. Others will continue to lead and play a pivotal role in the servicing of the financial industry, bringing traditional and modern technology, bringing the TradFi and DeFi, as you just phrased it, Martin, together. We will certainly be part of that from a D7 perspective. On the 3-4 points regarding the crystal ball, Steve, I would say, even though we're talking about securities, I think MiCA will be very important as it comes into force and provides further opportunities and clarification for the market participants in the non-security space at a European level. I think that is something where we'll see more harmonization and more clarity at that EU level becoming available. I also do think, back to the initial discussion of interoperability, again, between TradFi and DeFi, we will see a vast increase in institutional scale of real-world security tokenization, and then interoperability between such platforms, be they on-chain or off-chain platforms, to create that linkage and create that liquidity. That interoperability will be particularly important, as we said, for the creation of mobility capabilities for securities on and off chain, and then reuse on chain. And I do hope, as a last element, talking to the cash side of things, we're very hopeful to, and we hope to see very soon a wholesale central bank money digital coin becoming available on a normal BAU basis, if you like, quickly following the trials, perhaps not in the course of 2025, which would be fantastic, but shortly after. So if we talk about 2-3 years, I think that central bank money digital coin for wholesale banking will be there when we meet again in 2 or 3 years at the latest, I would hope.
Thank you. John, any final comments on the trends?
Yeah, I think the themes we've touched on throughout this conversation, so development in law of regulation, development, as Thilo just said very clearly, in terms of digital money, both wholesale central bank digital currencies where central banks choose to introduce them, but also tokenized deposits, HSBC, as well as WCBDCs. We're very committed to developing tokenized deposits, and we're developing capabilities on that at the moment. And what's really interesting there is if you can have more rapid settlement finality for payments, you can aid settlement finality for asset transfers, as we said at the beginning of this conversation. So we see those trends, the development in money, the development in law and regulation, all helping to drive liquidity, which we referred to several times in the conversation.
Thank you, John. And that concludes our panel today. A big thank you for my panelists and all of the interesting insights you gave. Thank you very much.
Thank you so much, Steve Jacoby there, and his fantastic panel speakers, Basak Toprak, Martin Watkins, Dido Derenbach, and John O'Neill. And they gave us plenty of keywords and keywords for the next conversation. As John was just emphasizing, for him, the underlying technology is just as important as regulation. And this ties back to what we heard from Ronit Ghose early on in his keynote, when he said that trust in finance is important, and regulation provides that stamp of trust, so we allow banks to handle our money and enable payments. But I think it's fair to say that trust in crypto products has been shaken repeatedly in recent years, chiefly by the bankruptcy of FTX in 2022, but also by the collapse of crypto-friendly Silvergate, Capital and Signature Bank, two systemically important lending institutions for the wider crypto industry. And then, of course, trust in stablecoins has also been shaken by the collapse of stablecoin Terra US dollar in 2022. And then at the beginning of this year, the depegging of true US dollar. And I'd like to quote the words of the finance minister of Sweden, Elisabeth Svantesson. Sweden, of course, held the EU presidency in the first half of last year when the EU launched the already cited Markets in Crypto Assets regulation, MiCAR. And she said at the time, it gives you an idea of the mindset of what the thinking is in public governance bodies. The collapse of FTX underlined the urgent need for imposing rules which will better protect Europeans who have invested in these assets and prevent the misuse of the crypto industry for the purposes of money laundering and financing of terrorism. And the EU is in good company, as we already touched upon, because also other governments around the world are in the process of developing crypto regulation. And then, of course, IOSCO, the International Organization of Securities Commissions, has laid out its 18 recommendations for global rules for managing crypto and digital assets. And so our second panel will assist us in making sense of these developments and endeavor to ask the question, are we actually ready for regulated crypto? To lead the discussion, I am delighted to welcome Luxembourg for Finance's very own Head of Business Development, Chris Hollifield. In his role at LFF, Chris advises fintech and financial companies looking to develop cross-border activities throughout Luxembourg-based platforms. He also advises on the development of the ecosystem in Luxembourg and on synergy creation with other key financial centers around the world with a focus on East Asia. And I happen to know that he speaks excellent Mandarin. So great to have you with us here. Chris, I hand it over to you and your panel.
Well, thank you, Judith, for that introduction and for setting the scene so well for this panel. In this panel today, we're discussing the topic of are we ready for regulated crypto? And in this discussion for this next 30 minutes or so, we'll be trying to look at it from three different perspectives of who we are when we're talking about it. Firstly, the regulatory side or the legislator. Secondly, then obviously the clients themselves. And thirdly, the industry that actually is providing those kind of supports for crypto activities. And so for this panel, I am delighted to be joined by three excellent speakers who I will now have the pleasure of introducing. So firstly, we have Ami Nagata, who is the Director and CEO of Bitflyer Europe. Bitflyer is a major crypto exchange founded in 2014 in Japan. We also have John Cronin, who is the CEO of Zodia Custody Europe. Zodia Custody being a digital asset custodian backed by Standard Chartered, Northern Trust, SBI and National Australia Bank. And then finally, last but not least, we have Biba Homsy, who is a lawyer, a DLT lawyer and specialist in both Luxembourg and Switzerland, and is also president of Let's Block, which is the Luxembourg Association for Crypto Professionals. So welcome to you all and thank you for joining today.
Thank you.
So maybe to kick off in that exact context of three different approaches to looking at what we mean by are we ready for regulated crypto? Maybe looking first at the regulatory or the legislative position of are we ready from that perspective? And so my first question, which I'll address to Biba in the first instance, is really about the European context. So MiCAR is obviously coming into force over the course of this year. And what do you think? Is it sufficient to bring crypto assets up to the same regulatory standards as traditional securities? Or are there further areas that you think still need additional clarification?
I like very much your question, because you have the word sufficient and same standards. But same standards to what, you know? I think we are old enough to recall what chaos, I would say, was the implementation of MiFID II for Luxembourg, and how it was difficult to actually implement. And we were talking about an industry that was mature enough, had sufficient look back, knew where to go. And now we are asking a whole decentralized cross-border industry is the very first regulation worldwide mature enough and sufficient enough to standards of traditional. So for me, I would say, if you are a regulator or legislator, they are going to say, we are not here. We are just in the midst of implementation. That's definitely not the same. We are not the same standard, which I believe is a lot already to ask, and we'll speak about that today. But I mean, that's huge to ask an industry that has, well, say, I'm not going to say 10 years, to be honest. Let's say 5 to 7 years, really look back and say, are you sufficiently enough and robust? I mean, in a certain way, and I think that's really my key message today. Let's try to be proportionate. Yeah. Let's try to be adequate to one industry. And the introduction was really interesting, because we speak about FTX and we speak about investors, for sure. That's one type of asset. But be regulated, be organized is a good thing. Going in the whole direction of over-regulating, that is not proportionate.
Yeah. Okay, so it's still a nascent industry with still some room to develop. Maybe Amy, turning to you next, because obviously, as I mentioned in the introduction, there's a certain, cross-border nature of your organisation's activity. What's your opinion on preparedness outside of the EU for crypto? And are there some jurisdictions that you think are doing a good job, basically?
Well, I think there are pros and cons depending on different jurisdictions. Some go very strict, some go for no, not really a regulation. So for example, if we talk about Japan, because of some tragic or sad incident of hacking history in Japan, they went to control, or they went to regulate so that the customer asset is strictly always protected from those hackers, for example. Those are specifically done because of the history that happened in Japan. And now I think 95% or over 95% of the customer asset has to be segregated in an offline cold wallet at any time, which is a lot stricter, for example, compared to MiCA. Now, is it a good thing or not? That is up to people to judge. We're not here to judge if the regulation is good or bad or sufficient or not. But there are differences, and I think it's important that each jurisdiction learn from each other to say what's working and what's not working. And if we make it strict here, does it really make sense to, follow that or not? And so MiCA is still very young, well, not even really there. So we will see in the course of coming years what in MiCA is good compared to other jurisdictions. I respect the fact, and I welcome the fact that Europe is trying to make this regulation Europe-wide, which is a very difficult mission to achieve, right? Because there are so many different players and different NCAs which have different agendas. So no, I respect that, and we're going to do everything to follow what we need to. But yeah, we'll see where this leads and where this brings the industry.
Maybe coming to you, John, as well. Obviously, Zodia is active in a couple of different jurisdictions. So how do you see this kind of exactly what Amy was talking about here, this slight difference of regulatory playing field, affecting a business like yours? Do you think there's a need for a greater level of harmonisation across borders?
Thanks, Chris. I guess coming from a Zodia perspective, we're a regulatory first firm. If you think of our parents, and we were born as Standard Chartered, but effectively we're owned by 4 banks between Standard Chartered, Northern Trust, SBI, and National Australia Bank. So we come very much on the institutional side and very much regulatory first. We have operations in the EU, the UK, Hong Kong, Singapore, Japan, Australia, and we're looking at UAE and US at the moment. So from a regulatory perspective, we need to have regulatory experts in risk and compliance in each of those jurisdictions, because there's a different regulatory burden in each jurisdiction. This then probably follows through to operational burdens where we must operate. Our operations must be slightly different to consider the regulatory burden in each jurisdiction. So there's a significant lift and a significant involvement both from a regulatory and operational side and operating in different countries. As regards to the question on harmonization, it would be very welcome, of course, but given the realities of life, and Amy touched on it there, is, you have different jurisdictions and different regulators with different agendas and different viewpoints. Harmonization will hopefully happen, but if we look at traditional finance, we don't necessarily have harmonization across jurisdictions like that. The other thing I'll say with digital assets and the crypto side of things, and one of the things I love about being in this industry, is it changes so quick. And it's very hard, and in fairness, from the regulatory perspective, it's hard to keep up because it just moves so quick.
So it's still very early days. There's obviously the different approaches to the regulator, and then also just the developments in the sector make it difficult to create that kind of level of harmonisation on a regulatory sense that makes sense. Right, so maybe I'm just moving now to talk a little bit about client dynamics and how that's changing with this kind of incoming sort of regulatory focus, shall we say, in major jurisdictions. Are you seeing that the more stringent regulations are having an impact on your client bases, and what sort of shifts are you seeing there? Maybe if I come to Amy first on that one.
Yeah, I think so because MiCA is coming, I see a lot more interest from the traditional institutions coming into crypto because they feel that it's more protected, there's more structure and framework. Before they were interested, but they didn't dare get into because there was this uncertainty, is it going to be okay or not for them to be in this space? And since MiCA passed, I hear a lot of stories of, institutional investors or institutional players or even banks trying to think of a business that involves crypto. And that is one of the reasons why we really welcome MiCA, because it gives a structure to the industry and this sense of security, if you will. So yeah, that's a change I see.
Yeah, so a big uptake in institutional assets, basically due to the fact that there's a regulatory framework that somehow gives it an authorization from the regulator that this is an asset class they can invest in. Maybe coming to you then, John, particularly since you're working directly in that field, do you see any changes in the sophistication of those institutional clients in terms of how they sort of trade and then also custody those crypto assets?
Yeah, definitely, Chris. There's certainly been an evolution in the last 2 years, and we open with the mention of FTX. We deal solely with institutional clients, so this is really our space. Institutions need certain things to be able to come into this space, and one is familiarity. They need to look at an infrastructure that's familiar to them and that they've known from a traditional finance background. When I speak to institutional clients, they're comfortable with the investment risk in digital assets. The aspect that they need to get most comfortable about is operational risk. And I would have said the industry hadn't quite got there and is evolving towards there now. If there's 3 themes that I've seen in maybe the last 12 to 18 months is, first of all, self-custody is done. That died with FTX. And what we're seeing is off-venue settlement, where people do not want to put their assets on venues, on trading venues, and the assets stay with a custodian, and there's an end-of-day settlement. That's certainly a big theme. The second big theme I would see is yield. Clients want to make yield on their assets, so either that's staking for proof-of-stake networks or borrow lend or whatever. People are not just content to just hold the assets; they want yield too. And the third big theme I've seen in the last 18 months has been tokenization. And tokenization was pretty popular maybe in 2017, 2018, and everybody thought we were going to tokenize the world. There's been a lull since, but certainly there's been a much, much bigger focus on tokenization from lots of the large institutional players. BlackRock been probably the most vocal and prominent, from Larry Fink's speeches relatively recently.
Yeah, so that's, I mean, again, making use of tools that were available to traditional securities, also essentially in the crypto asset space, reuse and collateralization and so on, and then tokenization, new assets being brought on chain. Maybe just moving on to one question I know in our sort of prep has been attracting some quite interesting discussions. I want to ask about the cash side, because obviously we're talking here about a crypto ecosystem or a tokenized securities ecosystem. But do you see incoming regulation really making transactions easier also on the cash side? Because obviously that's particularly how you get on and off crypto versus fiat. What do you think? What are you seeing? Maybe I'll come to Amy first, and I think John might have some opinions as well on that.
Yeah, sure. So for the cash side, we need banks to be collaborative. Because we're based in Luxembourg, I can only talk about Luxembourg for now. In Luxembourg, the banks are not that ready yet in terms of providing bank accounts and things like that. It's very complicated and I think the fundamental reason for that is, well, one of the reasons for that is because their compliance officers or risk officers are not aware of what crypto is, or they're trying not to look at it too much yet because they didn't have to before. Now that MiCA's coming in, I think they start to have to look into it, and if we or any crypto company goes to a bank and say, okay, I would like to open an account with you, they cannot say, oh no, because you're crypto, we don't open an account. Yeah. Because they themselves, I mean, that's what they say now, but most of them, but they themselves will start to be in that business very soon, I'm sure. Then they cannot use that as an argument, right? Oh, crypto is risky, we don't touch it, because the other part of the bank is touching it. So when they are ready to onboard and to be very fluent, let's say, in this industry, then I think the cash side of things would be much easier. Now there's a lot of blocking points, which is not mature yet, I would think.
Yeah. John, do you have anything to add there, perhaps?
It's funny, Chris. I first got involved in digital assets in 2017, and I'd set up a firm. And one of the things I tried to do was get a bank account to just to do payroll and expenses. And because the firm had a digital asset piece on it, we were declined by every bank account, and it was a very traditional firm. We weren't really dealing in digital assets. We were putting structures around digital assets. We were in trading, but even just to get that account was extremely difficult at the time. I'm not so sure how much has changed between then and now. Certainly when we talk to clients, the on-off ramp leg is always the more difficult piece. Getting banking is always a difficult piece for anyone in the space. And I think there's a general nervousness among banks, not just in, I know Amy mentioned Luxembourg, but I'd say that's across EU. And if, Chris, you opened with, we've seen what's happened, Silvergate signature, it's also in the US. So that cross between is still a challenge.
Okay, so still an area where, if we're coming back to the question, where are we ready? There's still some work to be done in that kind of space, by the sound of it. Maybe Biba, coming to you. Do you get the feeling that investors are still viewing crypto as totally separate from the other assets in their portfolio, or is it just increasingly an asset class that's part of a greater whole? What are your views in that space?
I think the whole discussion that we had today is that it's the bridge between traditional finance, institutional finance, and the crypto finance is actually getting closer and closer. The only thing that I see is typically we are talking about crypto assets in general, not cryptocurrencies. The fact is that if you want an asset manager to have in the portfolio all type of assets, including crypto assets, you need to have tools that reflects correctly, typically the valuation of the assets. You need to have tools that are encompassing this type of new assets. And as Emi said it very, very brilliantly, is actually that it's just a question of when they want to accept that that's a new type of assets and how they are going to deliver and offer that. For the banks or the CASP or any institution that wants to offer this service, if they already embrace the technology, they are going to be cheaper and they're going to have a lot of better margin, actually. So it's a question of having the right tools to offer the better service.
So ecosystem and buy-in are still kind of key points then. Right, and then finally maybe coming over to are we ready, we being the industry, the ecosystem around crypto itself. Maybe again, John and Emi in turn perhaps, how are you actually adapting your businesses to new crypto regulation? I mean, are there changes coming here? Maybe I'll start with John and then come to Emi afterwards. John, you're on mute, I think.
Sorry, Chris. I wouldn't necessarily class it as adapting to new crypto regulation. The regulation is business as usual. It's what we do every day, and we will do every day because it's moving towards being a regulated industry, and dealing with regulators and dealing with regulation is part of the normal day-to-day of doing business. So I don't really see that much adjustment for there. What I do see is certainly the industry is maturing. If there's an area that Luxembourg is ahead of everyone else, it's around the digital asset funds. Certainly the CSSF came out last year to allow, or earlier this year, sorry, to allow 100% digital assets in a RAIF. We've seen firms like Six Monks emerge as an AFM that can do digital assets, and that's a first globally up to date. All crypto has generally been in offshore jurisdictions, which limits the ability for institutions to get access to those because they may not be able to allocate to those offshore jurisdictions. But when I speak to clients and they talk about an AIF, a European AIF, one client in particular, I remember the phrase he used is, once it's in an AIF, I can allocate to it. It doesn't matter if it's Bitcoin or bananas, it's an AIF. I can allocate to that. I can allocate to this offshore fund. So I think that's certainly a change we're seeing. Luxembourg is ahead. We're looking at some quaifs in Ireland, but they will be slower. The Irish regulators are a little bit slower on that. But where that has impacted the industry is the growth of partnerships, and we need better and more partners across the ecosystem, because you can't just have an AFM. You need a custodian, you need a depository bank, and we're seeing depositories like Securities and Aztec come into the space, Northern Trust, and you need fund administrators. You need auditors, and certainly as the ecosystem develops, those actors will come in and make the whole space a little bit more investable.
So a full ecosystem really needs to kind of develop still. Maybe Emi, just coming to you, obviously, Bitfly has quite a long history. So, I mean, how do you see your business adapting to new regulation?
Yeah, I agree with John in the fact that regulation is business as usual. We will, because the regulation will be updated, upgraded all the time, and we need to follow that. The fact that we talked about the harmonization of regulation across the globe, the fact that we are in different jurisdictions, and then we have to see if one business model will match all the regulations, I think that is somewhere we need to kind of see, if necessary, make some tweak here and there. But so now we're in the middle of discussion with the CSSF to discuss the license, and some interpretation of the text we may not agree, or it may not be clear. So it is a continuous discussion that we need to have, and but fundamentally regulation is something that we will abide by, and I think all the players should abide by, and it is obligatory to have that mindset within the industry for the industry to mature.
That's actually a really nice segue then onto my next question to Biba, which is, obviously crypto has a certain reputation, and so some parts of crypto have a certain reputation for being relatively unregulated or lightly regulated. So how do you think the emergence of these kind of regulatory frameworks, not just in Europe but around the world, what do you think that has as an impact on those sorts of regulatory light models that exist elsewhere?
Yeah, I think it's, at the moment, the regulation globally is very fragmented. Yeah. So it's, regulators need to learn a little bit. They are doing a lot, but they need also they are looking at what Europe is doing, to be honest. What I've seen with discussion with other regulators, training with other regulators, that shows they are looking at it. Which means that it's inevitable that a lighter regulation will be a little bit tougher in the future. We spoke about IOSCO before, in the 90s, there was all the discussion about market abuse through the regulators, and then they set up what they are calling IOSCO MMOU, which is the framework to do requests for market abuse. I think we are going in this direction, meaning that they are going to work a lot about cross-border information. We are also having in the tax area the exchange of information coming next year, end of next year. It's going, as John said before, it's going in this direction. But the exchange of information with regulator is also going in this direction, which means as well that there is something we did not address, maybe we can address also in the perspective, but which is the recognition or the equivalence of the third party's country, the third party jurisdiction. If there is a bloc like MiCA, what about Asia against or towards EU, the same for the US or for any other countries? Where are we going in this direction? Yeah. What are the steps? We are so focused in the EU at the moment for the implementation that suddenly, it's a cross-border asset. Yeah. That's something that is going to impact also the other jurisdiction. Mm-hmm.
Okay, and maybe I'm just aware of the time. Just to finish with at least some future gazing. Regulation is coming, but it sounds in all honesty, it sounds as though it's nascent and still quite fragmented, and the ecosystem also is still in a state of development. So, if we're casting our gaze forward 5 or 10 years, as we discussed previously, the securities or traditional ecosystem has had many years to kind of adapt to this, whereas crypto is still quite new. How would you see this impacting the way the industry functions, sort of forward 5 to 10 years? I'll pick on Amy first, perhaps, and then we'll move from there.
Sure. I think 5 to 10 years in crypto is like light year away. I don't even know, where to start, because we don't even know in 3 months what's happening in the technology, right? But anyway, I think the key is the regulators will learn what the market is about with the implementation of MiCA, because they need to really start supervising not only the ML aspect like they do now, but also in the operation, in the technology and everything. That will really mature more the discussion between the regulators and the regulations. They would surely, I think there will be MiCAR 2 or something similar, which hopefully will be a bit more in a harmonized, standard with the other authorities, like Biba mentioned. What is the equivalence of MiCA license in other jurisdictions? That kind of consideration needs to be made.
Okay. Do either John or Biba want to pipe up here? Or?
I was equally laughing with Amy on the question, Chris, and not to denigrate your question. So I guess first of all, if the space is going to succeed and it's going to bring institutions and it's going to become the big deal we all think it's going to be. It's going to need regulation, and that's no industry can do it without that. And I know I'll have some crypto degens who will probably argue and say we shouldn't have it, this, that, and the other. But to be realistic, we need that. The piece on the question I was chuckling at is, to Amy's point, is this space moves so fast, and I was thinking about it. We didn't have Ethereum 10 years ago. We didn't have DeFi. We didn't have ICOs. Solana is the 5th biggest asset, 71 billion market cap, and we only got that in 2020. This space moves so quick. And that's what makes it so interesting. And, we don't know what the next big thing will be. We don't know where the space will be in 3 years. And it's about probably being adaptive and be able to be reactive to changes. From a regulatory perspective, I think, it's very difficult for regulators. It's to keep up. And I think the collaborative approach with the industry is probably the best way to go about it, because there are mature players, there are people from traditional finance that have moved into the industry now who want to do things in a right and proper way to protect investors and protect themselves. I know from a Zodia perspective, do not want to get our clients in trouble. We do not want to get ourselves in trouble, and we certainly don't want to get our parents in trouble. So we want to do something in a compliant and regulatory manner, and that collaboration, I think, with players in the industry and regulators is really, really important in a space that moves so quick. We need to learn together.
And well, maybe Biba, just again conscious of time, I'll just give you the last word also on MiCA. If is there something that you think that is going to be coming in MiCA 2?
MiCA 2, NFT for sure, DeFi for sure, exchange of information for sure.
Okay. So, I mean, in summary, thank you to my very excellent panelists for sharing their opinion. I think, it's very clear from this that, if we were to take a controversial opinion, are we ready for regulated crypto? No, but MiCA is a very good starting place for it. And the pace of the industry and the international cross-border focus on this is certainly meaning that it's going to be a topic that is going to come back in years to come. So thank you again for all three of our panelists for joining me today, and back to Judith for the next session.
Thank you so much, Chris Hollifield and his fantastic panel speakers, Emilie, Biba, Homsy and John Cronin. And so we covered various building blocks of this transformation that we see underway, what we call digital finance. Our next speaker, Dariusz Yazdani, will attempt to pull some of these building blocks together, look at technology, look at regulation, and cast the view outwards. As we just heard, 5 to 10 years are light years in this field, but we attempt to look at the trajectory from what we now know as open banking onto open finance. So a warm welcome to Dariusz Yazdani. Again, a warm welcome, Dariusz. Good to have you with us here live in the studio. So I had a sneak preview at your presentation, at your report that is also available to the audience on the website of Luxembourg for Finance. It carries the words revolution in the title, and it actually says open finance will redefine finance as we know it. These are big words. What do they mean?
That's a good question, Judith. So if you look at revolution, revolutions have the result of a radical change at the end. Revolutions take some time, but when you look at it, there is clearly a change to the status quo when the revolution started. Now, let's take an example of the French Revolution, right? Or let's take the second industrial revolution, or just looking at personal computers becoming household goods. These really changed either the society or the industries that were there. Now, we do believe that open finance is the genesis of a revolution within the financial services industry. Now, if you look at the financial services industry, look at how online banking, how online brokerage, how mobile payments have changed the face of the industry. And now imagine a time in a few years where clients will provide their data to one financial services player, and he can take all of that data and give unbiased advice to the client. And there are no more silos of insurance, asset management, wealth management, payments. It is all one holistic part. Imagine where you don't have AML and KYC challenges, where it is as easy as ABC. So that is what we mean when we talk about revolution and genesis of that revolution. And it will be core for asset managers as well as banks and insurance companies and payments companies to adapt to that revolution.
It sounds a little bit scary, though more convenient for me as client, as consumer of financial services. So what will be the driving forces that will reshape finance as you see it?
So if you look at it, the financial services industry has been a very closed industry as such, because if you own the client's data, it was your client. So that shift where you are forced by regulations to share the data if the client gives you the consent has a very fundamental impact on the industry. Now let's look at those drivers. One of the key and foremost driver is regulations. Now, if we look at it, if we want to take an example, we see how the ESG regulations have impacted the asset and wealth management industry, where now about 50% of the assets are in ESG. And now, if we look at towards open finance, the convergence of FIDA, PSD3 and PSR, those convergence will provide that we have an exchange of data where players are forced to provide those data, and this will radically change at how asset managers, insurance companies, banks, and payment firms will have to adapt. The second driver is definitely the shift from baby boomers to Generation Z and millennials. Now, look at me. I'm still the baby boomer generation. I still know the Nokia when it was in the bricks. You look at my kiddos, they don't know a time without Wi-Fi. Now, that shift where these generations are more tech-savvy, and also they are much more open towards sharing data as long as that data is secure, we will see that demand from those generations towards a more holistic advice, towards more products that are really tailored towards them. And what we will see is really that shift of power from a push towards a pull. What does that mean? Before, products were sold in the financial services. But now, clients will define, and we will have to tailor-make those products for them, and that is a clear shift and a revolution within the industry. The last driver within that is definitely technology. Now, if technology wouldn't be there, we wouldn't be discussing about open banking or open finance. If you look at the development of APIs, which are the core for banking and for open finance, as well as open banking, which was before. But with combination of cloud technology, with combination of AI, how we see that developing in the 5 years is definitely going to reshape this industry.
Now, the next question logically would be, how will it impact the different industries within the financial sector?
Sure. I mean, Judith, if you look at it from a payment sector and the banking sector, which have already been with open banking, they have come a long way. Let's take payments. So if you look at it, account-to-account payments, which are still in their baby shoes, they will gain more popularity. Digital wallets will become the standard, and it will extend their growth, what we have already been saying. Payments as a service, from B2B perspective, will become a standard. And what we will see is an increasingly instant economy, which means that payments will be instant. Forget those T+1s or multiple hours. It will be right at the spot. If we then look at banks, banks really within open finance have a strategic opportunity. Why is that? Now, if you look at it, banks have been the primary connect to the clients. They have already a lot of clients' data, be it your electricity bill, be it what you are paying for the supermarket, all of those data is there. Now, if banks would adapt to these new realities and provide unbiased advice and best in products advice, we would see them develop. If they do not do that, we could see the rise of new players. We are already seeing neobanks being there, using data. So it is to the incumbents to see how they can adapt to it. But also, they would be able to further monetize those data. As they have those clients' data, even the regulation would allow them to monetize the data, to provide it to other financial services players, given the consent of the client. As banks have already been using APIs, they are also very much on the forefront of setting standardizations within APIs, because what we will require in order to bring the cost down, that everybody, the whole industries and the various industries do agree upon the standardization of those APIs so they can exchange the client data efficiently. Now, if you look at the asset and wealth management industry, within the asset and wealth management industry, we would see the rise of holistic advice and portfolio management. We would look at hyper-personalization of products. We are already seeing some of that happening with direct indexing. I'm sure, Judith, you are aware of robo-advisors. With those drivers of generational shift and technology, we will see the further rise of those robo-advisors. We will also see the proliferation of distribution within the asset management industry. If you look at it currently, the asset managers provide the products and the banks or IFAs distribute those products. Now, with these APIs, asset managers could directly advise clients if they would like to penetrate that and cut out the intermediaries. So there is a clear point around the intermediation within the industry that will have the possibility to be cut out. So, and the last but not least, from an insurance part, insurance, we will see the rise of platforms where you can compare the various insurances. You will see the rise of embedded insurance. We already have it if you are going traveling. So for example, you just book a ticket, you already have travel insurance that pops up. But think about it that you already have the client data populated, and you can really put a very clear, individualized product for that client. And the last, within the industry of insurance, what we will see is the rise of on-demand insurance. Because, for example, you will know how many accidents the person has, all that data is there, or if he has a garage, when all that data can be exchanged, that means that you can provide really tailor-made products, on-demand insurance products.
So Darius, you keep mentioning data as being central to this open finance revolution. And I'm thinking of the demographics you spoke about earlier, especially older demographics, for example, in Europe, are much more aware and sensitive around concerns regarding security and privacy. So what do you think will be some of the biggest challenges that firms need to overcome to truly harness the potential?
Judith, you just mentioned it. Yeah. I mean, If you look 20 years ago, misuse of data and hacking was not a huge issue. But if I look at the last 5 years and look at what has happened at government levels, at corporate levels, we have seen cyber attacks. So clearly that misuse of data, be it that you have external misusage through cyber attacks, or internally misusing the data not on purpose, but accidentally, because you are allowed to the customer's extent how to use that data. So that is the key challenge that all financial services companies will have to address once they are moving into this open finance realm. The other challenge is clearly the lack of standardization. I already pointed out to the banks that they can be at the forefront of providing that standardization. If you don't have standards within the various industries in the financial services or within players, and everybody is using its own technology, own type of API programming, then that won't be efficient. That would have a cost and a friction. So clearly the lack of standardization is one of the points or the challenges. Then the cost, implementation cost. Our industry is not very, let's put it, not very happy or ready to invest in technology.
Not just yet, maybe soon.
That's the hope, right? So if you look at some of the industries, and I'm not going to name which industries within financial services, still use Excel sheets, right? And we should be further in. So clearly, if we want to be at the forefront, if a corporate wants to be the Tesla of the financial services industry, then they need to put that investment and clearly be at the forefront, because they can be then the leaders within that as we see that revolution really materializing. Then clearly there will be a greater transparency and control by clients. Again, I pointed out to the fact that there is a clear shift within this revolution from a push to a pull, which means that the clients will demand and that transparency will need to be provided. But that transparency comes also with a challenge, because then you have nowhere to run and nowhere to hide, right? You cannot just say, you know, these are my fees, but you have to explain what is the value you are providing for that, yeah? The next challenge is that you will have competition. And we are used to, you know, in the asset and wealth management industry or in the insurance industry, normally we see the competition from other insurance companies or from other banks within the banking or from other asset managers within the asset and wealth management industry. But that competition is going to become much bigger, which means you are not going to only have competition from other insurance companies, but you need to take care that that competition can come from banking or from insurance, but also from outside of the industry, because that data can be provided to others within, if you are talking about embedded finance or finance as a service. I'm putting now all insurance payments as a service, then other new players can arise from there. So you have to have that on your radar screen, that you are not looking at your own insurance industry, but really have a wider view of that. And then there is the point of customer selection, which means you need to be closer to the customer. And I know since the 80s, as I have been in this financial services industry, being near to the customer has always been a lip service. But now when we see that shift, that the power goes to the client, that shift is clearly that you need to be able to address to the client, communicate to the client, provide the right product to the client in order to be successful in this new world.
It does sound like a real challenge, especially for those more traditional institutions. Do you think they will still exist, those traditional banks? And if they are to succeed in this transformation, open finance revolution, as you describe it, what might be the key success factors that you would see?
You see, revolutions never completely let the incumbents die out, right? But they can become marginalized. Now, I give the example of, you know, Porsche, BMW, all of them were working on electric cars, right? And you name it, General Motors, because I'm German, I'm taking some German examples, but we can take the US examples or the Japanese examples. But then Tesla came in, right? And put everything together, right? And now Tesla is much more valuable than some of those car companies, right? It's one of the top valued car companies from a market capitalization point of view. So if we want that the incumbents, that those financial services players that are already there, that they can survive and thrive, more importantly, the first part would be to strike the right strategic balance. In German, we say you cannot be fish and you cannot be meat at the same time, right? So you need to decide at a board level, where do you want to go? Do you want to be somebody who is taking that data and utilizing that data to offer added value services and products to their clients? Or do you just want to be the data holder and you are providing those data to other financial services players or other players, and you are trying to monetize that data? Or you just don't want to be in it because you don't believe in it, yeah? Remember, Kodak had the digital camera license, but they just said, we are a chemical company. We are not in the camera company, yeah, or in the film developing company. And the rest is history, right?
Absolutely.
So that's striking the right strategic balance, and that is at a board level. A clear decision is key. Then you will have to adopt a very strong governance framework, especially when it gets to data, how you are exchanging the data, how you are going to use that data. Because if that goes wrong, you will see the regulators coming up to you, you will face heavy fines, but also losing the trust of your clients. So that robust data governance framework will be key. Then, as I mentioned already, if you are already a player within the financial services industry, you need to be careful about intra-industry competition, which means not only from your insurance place, but also from banking and others. Last but not least, you will have to anchor your customer base. You need to communicate towards them what you are going to do, how you are going to do it, and pursue new prospects. Because I think this is a huge opportunity. If we look at embedded financial services products through this data exchange, through this open finance, the sky can be the limit if you use those opportunities.
A fascinating world, an open finance revolution ahead. Thank you so much for your insights, Dariusz Yazdani.
Judith, yes, just one last point I would like to add on to it, is that I have a very short time here. So I would really motivate you to go into the report and read it, because we have also a lot of data in there. Given the shortness of time, I couldn't go through all those data, but I'm sure it will be of added value to our listeners.
Absolutely. Thank you.
Thanks a lot.
What a tour de force with Dariusz Yazdani, partner and head of global asset wealth management and ESG market research with PwC Luxembourg. And truly, I can recommend, take a look at the report. It's free for you to read. You can access the link on the website right here where you're watching the live stream. Again, the title, Open Finance, Genesis of a Revolution, truly gives you good insight with lots of good data and strategic advice. But please don't run away just yet, because we will carry on, lots more to come. And Dariusz already gave us the cue for our next conversation about the new PSD3, the EU's new Payment Services Directive. And our next two guest speakers will give us a more in-depth idea of why it is important and what we can expect from it. So, warm welcome to my guests in the studio, Nadia Manzari and Thibault de Barsy. Great to have you with me. I want to give our guests a bit of context about your background, and I start with you, Nadia. I know you consider yourself a passionate fintech pioneer, if I may say so, which ties back with your more than 17 years with Luxembourg finance watchdog CSFF, most recently as head of innovation, payments, markets, infrastructure and governance. But you did leave the CSSF in 2018 to become a partner in the Luxembourg law firm that specialized in fintech, and your passion for fintech then carried on when you recently launched your own firm, Bogner Legal, again with a strong focus on fintech, financial services in general, and also tech law. And you also share your experience and wisdom with the next generation as a lecturer for fintech, digital finance law and regulation for the master program at the University of Luxembourg. And over to you, Thibault. Since 2019, you serve as vice chairman and indeed general manager of the Payments Association EU, which you also have to launch in February 2020. Now, for those in the audience who don't know, the PAEU essentially brings together all the big players, the decision makers and the businesses that form the payments value chain in the EU member states, and also builds on the international network of its sister organization based in the United Kingdom called the Payments Association. And overall, you have more than 25 years or so of experiences in financial services, but also in the ICT sector, so bringing those experiences together. And you also share your experience with the next generation as a guest lecturer over in Belgium at the Zodia Brussels School of Economics and Management. So lots of expertise here in this room to talk about the PSD3. Now, I want to start with you, Thibault, with my first question, because I know you come from your annual conference, I think the third one, in Paris on October 10th, which carried the title Payment Tomorrow. What did you hear from the EU Commission in that regard, specifically to the PSD3? Because I know you had a high-profile speaker from the Commission.
Exactly. So actually, three key takeaways. So first of all, you know, the strategy of the Commission was set 4 years ago in 2020. In the meantime, the ECB has also developed its own strategy, but the Commission thinks that the strategy is still right. So no big updates there.
They think no surprises.
The objectives are right. So there is no big change expected there. Second question is, of course, everyone now is asking, okay, when is it going to be implemented? So basically, there is a first deadline, which is now the end of the Hungarian presidency. Then there will be probably modifications because there is a three-party dialogue between the Council, the Commission and the Parliament. Good news is that the work of the Parliament is done. And of course, those discussions will then probably continue under the Polish presidency, and that will probably lead us to 2027, actually, for the effective implementation of PSD3. Last but not least, and this might be some news to you, is that we will not see soon a PSD4. So that means that for the next 5 years, the Commission thinks that the market first need to, of course, implement and digest PSD3. So that means that there will be no big new change expected, which I think is good news for some players of the market.
Yes, a bit of stabilization. So that's an idea about the timeline that we can expect. Nadia, what do you see in terms of, say, 3-4 most important changes that are coming with the PSD3 and also the PSR that comes in the package with the PSD3?
That's exactly the change I wanted to mention as the first general change, the PSR, because many people talk about the PSD3 and being the review of the PSD2 and the new proposal, but we have here now a PSD, the Payment Services Directive, a proposal for this directive, and we have a proposal for the PSR, which I really welcome because we have seen since PSD1, also under PSD2, that there's a lot of regulatory arbitrage still within the EU, and the aim of both directives was to have a harmonized payment framework in place, but with the directive you have still a lot of flexibility and interpretation area, I would say, left. And that's why we still were facing over the last year this regulatory arbitrage, regulators as well as payment firms because of different application of the rules. So PSR, I really welcome this proposal because we have now a directive with the requirements to how to obtain a license, and then we will have and in this directive we will also have the supervisory rules for the supervision. And in the PSR, in the regulation, we will have all the rules and the obligation payment institutions need to apply or to comply with in order to do their business. So that's really, I would say, and I hope that this will reduce the regulatory arbitrage in the payment space. A second point is that we also have more clarity, that's also a more general point before going into the details, more clarity on the definition of e-money and on what e-money is. So we also, again, those discussions, I remember because I have been part of the discussion very in the beginning, 2001-2 already on the Payment Services Directive. And already back to those years, we were questioning sometimes what is really the difference between a payment service and an electronic money service, because behind the scene, operationally, they are nearly the same. So the difference at the beginning was that having this prepaid access, these prepaid cards, but over the years, those got lost, and it's the differences and the lines between those two services or those two activities were really very minor, and the framework were quite general, identical. And so this is also something now which is clarified in these proposals, where the electronic money services will be implemented, will be included in the payment services, and also the payment services will be adapted to the technical evolution and also to the, I would say the digital evolution of the services. So we really see the services a little bit refined, but nothing fundamental. I'm just giving an example. We had the discussions between issuing and acquiring. Now, those are two separate services because it was quite challenging sometimes. Also here again, different interpretations. Some member states decided that you could not do issuing without acquiring, and you could not do acquiring without issuing, which are two complete different services. So this is now clarified. And I think those are essential points which we have seen over the years. Through the two last directives, they came back all the time. One specific point is also now that this access to cash requirement, which is in the directive. We have this digital evolution, we have this incredible evolution of digitized payments and digital payment services. Nevertheless, we do not have to forget that cash is still needed in the society. We have the European Central Bank, who has reminded all the European national central banks are reminding that we need to keep this access to cash, to keep it also safe for the citizens. And here again, we see that there are solutions in the directive to allow, for example, merchants to offer cash services within their stores without being licensed. ATM services, independent ATM service will still not need to be licensed, but they need to have more clarity on the fees and on the information on customer. One fundamental point for me, and which I have seen also the market and the business is struggling with, is the central bank access, or the access to a payment account. I think that's also a very well-known problematic that payment institutions, electronic institutions, sometimes have problems or struggling to have to open bank accounts with bank or to keep the bank accounts with banks. It is a requirement already, it has already been a requirement in the first Payment Services Directive. There is an article in the text saying that you have to provide bank accounts to credit institutions. This has been reinforced in the second directive, but it seems still not to be sufficient for the market, and I've also put some instability for these firms. And now, and we have seen some countries, the solution for some EU countries was to provide their providers already access to the central banks. And this also now has been included in the directive, in the regulation, in the proposal, allowing, but it still is on the voluntary basis of the central banks, but that you can also, as a payment institution, afterwards have a safeguarding account with the central bank, so that you're not necessarily stuck with bank risk policies or strategy changes, and where you can then face a big issue for your customer and and your business. So I would say that's really, for me, also one essential point. Of course, like both PSD1, PSD2, and those are the objective of those regulations is consumer protection. We will see consumer protection further increased. The consumer will have enhanced consumer rights. They will have even better access to information than they already have in the existing regulation. There are requirements for clearer disclosures around the terms and conditions, about unauthorized transactions, where the liability point is clearer now, clarified in the new text, in the new proposal. Of course, stricter security and fraud prevention measures will come up also. I suppose Thibault will mention this also, because it's going to be challenging again. We all remember a few years back strong customer authentication, and it was a fastidious implementation, so it's I would suppose it's not going to be, but maybe Thibault will develop on that point. It's going to be challenging for the markets again to improve or to have even stronger strong customer requirements in place. But this is also in the current trend. We have DORA, we have this rising fraud on online payments, and we also need to have this resilience and security towards our infrastructure. So this is also, I would say, in a normal trend within the payment regulation. One important point here also is from customer authentication is accessibility. That's very important also to mention for people who have lower digital skills, for example, disabled people or older persons, providing them a possibility to have access to strong customer authentication is also here, or to SCA, I would say, a solution. There is a solution in the regulation on that point. Enhanced fraud reporting, enhanced liability for fraudulent transactions. So those are, I would say, also for the consumer protection aspect, the developments which we will see coming. And then, of course, last point, and then I stop here, it's open banking. That was the big, I would say, how do you mention it? Surprise, the big change of payment services Directive 2, and now we have still open banking aspects, but moving towards open finance. So you also see the impact of FIDA already in payments in this proposal, is opening also the access not only to payment data and not only allowing third-party payment initiation providers or account information services provider to exchange payment services data, but also broadening the scope of the data accessible. So that's, yeah, it's, people say it's a smooth change, but when you look at the text, when you look at the proposal and the regulations, there are proper fundamental changes.
It sounds transformative.
At the end it sounds, because we said it's going to be a smooth transition. It is. I think compared to PSD2, the changes are not. There are not as many changes, but the one we have. Fundamental, I would say, for me.
Yeah. It sounds transformative to me, and I take note of this discrepancy, the demographic discrepancies, that a certain part of the population needs still access to cash. I mean, this theme has been running through other conversations as well, that younger people are more readily embracing digital methods, and that these things need to be taken into account also when it comes to customer authentication. So Nadia already teased what the perspective of the industry will be, which you're representing here in this conversation, Thibault. So what is the perspective, and what was sort of the voice? What did the voices in the room say in the event?
Well, first of all, let us remind ourselves that PSD2 was considered as very positive for the industry in general. So basically our members rated PSD2 7 out of 10, if you like. PSD3 tries to fix the problems that were not solved by PSD2. So in that way, more an evolution than a revolution. So again, very good. However, there are challenges. So the ones that are mostly quoted by the industry based on the text right now are issues in safeguarding, transparency in cross-border payments, access to payment systems, and consumer protection, which might be misused. So let me just focus on 2 points. First, strong customer authentication. The big fear from most payment players is that in the implementation, because the text is quite general, but in the implementation that will be required, is that it's going to be too prescriptive. So that means we are not having a regulation on objectives, on ends, but on the means. And that would be very detrimental to new technology. So basically the actors are saying, please give us the choice of the technologies we will be able to use or invent to reach the objectives defined by the regulation. So that's very important. Number two, on fraud. So basically, the text says that there is a big responsibility on the banks and payment players to prevent fraud. But we all know that that's a bit too simplistic, right? Because we all know that fraud can be very complex with different people involved and different players involved in the value chain. So basically saying, okay, if there is a fraud, the bank should basically compensate the consumer. In all cases, that is going to be a very big problem because it can generate fraud in itself. It's moral hazard, as it's very well described in the literature. So basically here, the players are asking for a balanced strategy and implementation to prevent fraud.
So far, so good. I think we have to widen a little bit the scope because I understand that there are further pieces of legislation that will come into play around the PSD3 and the PSR, Nadia. Can you just, I know it's a deep rabbit hole, but can you give us a few building blocks to understand?
It's all part of the retail payment strategy from the Commission and all the other regulations, which I also mentioned already. We have FIDA, and I heard also in the discussions during the day, we talked a lot about MICA, the MICA regulation. All these regulations, of course, are interlinked. So if you look at the PSD3 and the PSR proposal, you have FIDA. We talk about open finance and open banking in the PSD proposal, with opening it to open banking, open finance. And FIDA is the regulation for open finance, to regulate this access to data other than payment service data, other financial data on customers, and to make the market, I say, to have a more interoperable market.
Wonderful word. Interoperability, yes.
Yeah, market within the EU. So we have PSD and FIDA interacting. You will have PSD3 and of course DORA interacting. We talked about strong customer authentication, fraud reporting, and as such. And DORA is the Digital Operational Resilience Act, which wants that all financial entities stay and remain financial resilient from a digital operational point of view. And of course, there you find the interlinkages to MICA the same. MICA is digital, it's the crypto asset services market, the digitalization and the regulation of those type of markets, those type of tokens, but you have the stablecoin and the e-money token which interact with PSD, and the same for AMLD, which is AML issues where the PSD also has widened the scope of obligations for payment services provider, and GDPR of course also. So you really see that the packages and the different regulations are strongly interlinked.
And from your perspective as expert in this field and lawyer, where would you say there are still weaknesses that still need to be ironed out in the legal text now, going back to PSD3 exactly?
There is one discussion which I was a little bit maybe missing in the text, but from the information I have, it is discussed in the discussions on the directive, is this discussion on the virtual IBAN. The European Banking Authority has issued, I think, in May this year, a report on virtual IBANs, and also here again differences in the interpretation between the member states, differences also between the qualification. What is a virtual IBAN? And a virtual IBAN is essentially an IBAN which is linked to a master account, which can, where you can link your customers. To have one master account, and you have then different, I would say, accounts attached to this master account. And many business models are built on this system of having this master account and this virtual IBAN for your customers. And of course, the report highlighted some challenges and also some risks for consumers, for financial institutions, for competent authorities, because of this unclarity of what is on this lack of definition, on this lack of rules for those type of accounts. And they were proposing, I would more or less, I resume, 3 solutions: abolishing the virtual IBAN, so forbid it, or align it with the normal IBAN definitions, or yeah, so that was a little bit the solutions in the report. And my meaning here is that we cannot just forbid such type of setup, but it needs clearly to be aligned, better defined. So in order to avoid regulatory arbitrage, in order to avoid also misuses of those type of accounts. But I think for the industry, even though now we have the central bank access or the possibility in the text, we still need this type of setup.
So it's still a work in progress. And to conclude the conversation, I'm mindful of time. Thibault, casting your eyes ahead, say 10 years, 20 years down the road, how are Europeans going to pay? What will the landscape look like from the perspective of the industry?
Well, we had a very good data from the Bank of International Settlements on that point during our conference. So first of all, the use of digital means of payments for transaction commerce is actually continued to grow. Very good. Point two, which is very strange, is that cash is here to stay, not only for the short and the long term, because actually pandemic has not fundamentally changed the habits of European. Why? Because there is still an appetite for cash, also for liquidity hoarding, and not for just commerce and transaction. Number three, of course, the big new thing is stable coins. And here what's very interesting is that actually we believe that there will probably be more appetite for wholesales CBDC than retail CBDCs. So it's much more likely to be proposed and to be actually used by the industry as a general mean of payment, if you want me to make a forecast, Judith.
And the final word from you, Nadia, you're casting your eye ahead?
I think I would agree with Thibault on the topics, and that are also the trends we see. Cash is, of course, now here to stay, because you also see it in every regulation that they really insist on this availability of cash in the market. We have also seen other markets who went almost completely cashless and to a stepping back. So
interesting.
So that's for me one of the points. But of course we will have more and more digital devices and digital ways of doing our payments. That's also
so this is here to stay, but still cash will also stick around. Thank you so much.
Thank you.
Nadia Manzari, Thibault de Barsy, and we'll continue. Indeed, fascinating conversation, and really one of the takeaways for me today, with all the digital evolution and as fast as it is, we will still somehow hang on to paper and coin. Will be interesting to watch. And we'll now go back to Ronit Ghose's keynote earlier when he spoke about artificial intelligence and said that AI will commoditize intelligence and advice and provide a huge boost of a productivity boost for the financial sector. And in fact, that's why he dedicated a whole chapter in the book specifically to artificial intelligence. And I want to put some data to this forecast. The McKinsey Global Institute estimates that, I quote, across the global banking sector, generative AI could add somewhere between $200 and $340 billion in value annually. That's about 2.8 to 4.7% of total industry revenues. And that's largely through increased productivity. So to tell us more about how this works in practice and how generative AI is being built out in the financial industry, I have the pleasure to welcome our next speaker, Dr. Jochen Papenbrock, who is joining us from Frankfurt. Now, Jochen is a financial data scientist, and he actually spent the last 25 years very much focused on artificial intelligence in financial services, working as a consultant, as an entrepreneur. He basically ran his own AI startup, and as a researcher with asset managers, with banks, insurers, and also central banks. Between 2019 and 2021, he served as executive board member for the EU Horizon 2020 project FinTech. And since 2020, he's a topic leader for the Gaia X project, which is a European initiative that aims to serve SMEs by developing a decentralized, trustworthy, interoperable data infrastructure in compliance with the EU's data protection laws. And since October 2020, Jochen serves as at NVIDIA as Head of Financial Technology EMEA and as Lead Developer Relations Manager for Global Banking. And today he speaks to us about how AI changes everything. Over to you, Jochen. Warm welcome, and the floor is yours.
Thanks a lot, Judith. It's my pleasure to be here, and thanks for the invitation. So my discussion, my presentation today will be about how AI changes everything. Before I talk about this, I think I need to introduce a little bit of concepts and technology know-how that's behind the AI revolution that we are currently seeing. This is important to understand where this comes from, to understand where this is going and how it will change everything. So first of all, we need to talk a little bit about technology, especially hardware, because accelerated computing is that technology, that one specific technology that enabled this industrial revolution, the Gen AI iPhone moment of AI that we are currently observing. So the past 20, 30, 40 years, we relied, for good reason, on general purpose compute, on so-called central processing units. So these are processors that run general purpose tasks, and they became faster every year. It's known as Moore's law. So there are more and more transistors put onto this one, and they accelerated the compute performance. But at some point, we ran into a problem because the amount of data was growing. Also, the size of these AI models was growing. For example, we talked today in these community models like Llama about 7 billion, maybe 70 billion parameters, and those GPT models are even larger, right? So we ran sort of into a performance to demand deficit, right? We needed more compute performance, but it wasn't there because the sequential computer, the CPU, it even came to a plateau in terms of increase of performance. So it was indicated a couple of years ago that we would need to switch to a compute model that is leveraging the idea of simultaneous compute, of accelerated compute. And one of the most well-known candidates or representatives of accelerated computing is the GPU, the graphics processing unit. So as you see, originally it was developed for computer graphics, computer games being a very complex simulation where a lot of computer visuals and graphics needed to be computed in almost real time. So the GPU has a completely different architecture, running simultaneously many operations with billions of transistors on that chip. And this is, by the way, something that now we can leverage for other compute-intensive workloads. Like 15 years ago or so, the financial service industry saw that Monte Carlo simulation for value at risk, for example, could be dramatically sped up with GPU compute. At the same time, people also discovered that deep learning, like matrix multiplication operations, is also something that is highly parallelizable and is a great candidate for running this on the GPUs, right? So that's where also NVIDIA started supporting TensorFlow, PyTorch, all these popular deep learning frameworks, multi-layer neural network frameworks to program these networks, to learn from data. And this even got further accelerated by the arrival of the transformer architecture based on the Google paper, attention is all you need. And now these days, the idea is really to train with gigantic amount of data and build these Gen AI models. And this is only possible with GPU acceleration. And I'll give you an example. The OpenAI initial run of training, it used 10,000 GPUs. And you can see today across the clouds, across the tech industry, there are hundreds of thousands of GPUs available in those clouds, but also in data centers, in research, for example, research data centers, but also private data centers. So these pieces of technology are important to train these large models. And maybe some people are not aware, it's also important to use these accelerators for running these models, because these models, as I mentioned in the beginning, have grown in size. So the runtime needs to be also accelerated. Otherwise, you would wait for a chatbot to come back with an answer for minutes or even hours, which is not feasible, right? So accelerated computing sort of is the driver of this AI revolution behind it. And the alternative would be to run it on sequential computers, which uses much more energy, takes much more time, and also is very costly. So a single GPU, yes, it might add some cost and some power consumption, but the workload is done so tremendously fast that the GPU could be switched off, used for a new job, right? So that makes it the lowest total cost of ownership, actually, with accelerated computing. When you have runtime, when you have training models, but also fine-tuning models, and even data processing. So also the loading of huge data files and the curation of data files can be GPU accelerated, resulting in lower cost. So it's an end-to-end workflow actually running on these machines. The thing, however, is a GPU alone is not something that will sort of implement or include AI into the bank, for example. There needs to be a full stack, because AI is a full stack problem. That means there needs also to be a software layer that is able to leverage accelerated compute end-to-end, is able to manage all these models and the model lifecycle and the monitoring of the models and even the preparation of data to train these models. So an end-to-end full stack accelerated computing platform, including software and hardware. This is how people these days build their enterprise AI, right? In NVIDIA, we actually put a lot of effort in developing software, embracing open source projects, embracing community models, open models like Llama, Mistral, and so forth, so that people like data scientists could still use the frameworks and tools that that are around, that emerge every day, that evolve every day, and at the same time they would be able to accelerate their data processing, which sort of also creates a completely new approach how we work. Because when we don't have the right infrastructure and, for example, train a model, and we discover after a few hours that we forgot to include a certain feature, well, then we need to start all over again, train the model with the added feature. So this will sort of waste the entire data scientist's day until they converge to a model, right? With accelerated computing full stack end-to-end platform, a data scientist is capable of correcting their mistakes, testing different parameterizations, testing different data combinations. So it's a sort of a time machine. It's a machine that helps them really succeed. And today, modern data science is done in exactly that way, which reduces the time to insight, reduces the cost, and increases the ROI. A lot of POCs, like proof of concepts these days, may not succeed because people are not leveraging the right infrastructure for this, the hardware and the software full stack platform. And this is something that now people understand that it's both these things that need to be combined, right? We at NVIDIA, we put a lot of effort into building operating system for AI that works independently or portably, which means you are not getting stuck into a certain, let's say, cloud infrastructure, because our portable enterprise AI operating system, it runs on every cloud the same. You just need the accelerator GPUs underneath. Also, you could use it to build an on-prem AI platform, which is very important when you have data, sensitive data that is not allowed to go to any of the clouds. In this case, you simply bring the hardware and the software platform to this data, right? And we now tend to talk even about AI factories, because every step of model curation, model building, customization, and running these models can be accelerated, can be optimized. Like in a factory, all these assembly lines are super optimized and they are orchestrated. And this is why we now talk about AI factories that sort of manage the entire intelligence life cycle of an enterprise, for example, of a bank, right? So it's less the question of human in the loop when we discuss AI, because humans will always be in the loop. There will always be someone who monitors the model, who builds the model, who tests the model, who validates the model. So that's not the question. The question is rather how to bring AI in the loop everywhere to support the humans that carry the knowledge. And this is actually where these AI factories are being used. They help people to do corporate search, enterprise search, retrieval augmented generation, building digital assistants, maybe even digital humans that help to interface customers. The basis for all these inventions and Gen AI applications is an AI factory. And an AI factory also needs to embrace the open source, open model developments. We all know about powerful models that are constantly updated. For example, Llama 3, Llama 3.1, Llama 3.2. There's Mistral, there's Falcon, there's many other community-based models. And by the way, NVIDIA has also built an open model, which is called Nemotron. So how do we leverage these models? How do we bring these models very quickly into production in an enterprise way, in a safe, secure environment? And this is where we have created a project called NIM. It's our flagship project at the moment. It is an inference microservice. So this is the way how to distribute AI models, how to fine-tune these community models, and how to bring them into inference engines using industry standard APIs and model support, running in containers that you can run everywhere. That means it can be in an on-prem way where we have an own data center infrastructure where you want to run these models, or it could be across different clouds. And this is where what I already discussed or explained. This is this portable platform where you just have your model, your own model in a container. And this is completely different actually than leveraging API-based models, like huge, gigantic models that belong to someone else that a bank would approach with an API call. It's a great way to build Gen AI, but keep in mind that this is not your model, right? Your model is something like leveraging Llama, fine-tuning this model, retrieval augmented generating these model where you connect your own data to this model and you can run it everywhere. So this is really the basis for a low-cost, efficient, and trustworthy way of building models, because you own the IP, you own the model, right? And it's not that hard to run or host, self-host these models, because there are these frameworks like NeMo or NIM that help you to manage the entire model lifecycle. So it's become very easy these days to build enterprise AI, leveraging these community models. And we sort of, as an NVIDIA software and hardware platform, an accelerated computing platform, we democratized this sort of model control and customization of these models, right? So this is basically wrapping up how AI changes everything, right? Banks or other enterprises will build these AI factories where they sort of own and maintain their own models, their own IP, their own data, because that's the treasure, right? That's how they differentiate in the future. And they will use these factories in the way that AI is always in the loop for the humans that work there, and that these factories are really able to manage the entire intelligence lifecycle in a very efficient way. Because think about orchestrating LLMs. There will be more applications that use a number of several LLMs at the same time, right? One for translation, another for code generation, a third one for understanding the intent of the user. So we will sometimes even talk about agentic LLMs. So it's an agentic system of large language models that need to be orchestrated and put together. And here we realize that it needs to be sort of an AI full stack factory approach that helps you manage these models, to update them frequently, to connect them in a way that is efficient, and also to optimize the inference, because these models are supposed to react in a super low latency. They have many, many users at the same time. You won't be able to build an agentic LLM with gigantic, maybe oversized black box LLMs that don't belong to your organization, right? You need these sort of AI and data flywheels that enable you to sort of participate in the evolution of these community models, and also in the open source world, right? So just to give you some examples, because this has been quite theoretic, but these things exist. There are financial service companies out there that already use such a technology and have implemented an AI factory. One of them to mention here is BNY Mellon, who have built an AI factory where they have an on-prem accelerated computing cluster. On top of this, they run an enterprise AI platform. And this way, they are even actually to also, they are able to actually also use GPUs in the cloud. So they could build a hybrid AI factory, depending on where they can save cost, depending on which data is super secure and safe and private, so they can't move it to the cloud. They can have AI in the loop everywhere, right? They use this platform, this AI factory, and especially the operating system, the software layer, to explore their models, because AI by PowerPoint is not working. You really need to test your models. You need to build POCs in a very fast way so that you learn, that you see fail fast, fail forward. What is the result of my model exploration exercise? Will these 1,000 shortlisted AI, Gen AI cases succeed? You need to test it. You need to find out. You need to find also a very efficient implementation, because going forward, once you have identified a POC that or use case that you want to implement and bring to production, you cannot change the platform. You need to keep going on the same platform ideally, and that platform is super scaling, where you just add more GPUs to the problem and you can serve more customers or reduce the latency, or even both at the same time, right? So BNY Mellon not uses this AI factory and enterprise AI platform for exploring the models, discovering hypothesis testing, monitoring the models, but also for scaling these models in production, right? Some other examples exist. One of them, very interesting, is PayPal. They use accelerated computing, GPU computing, to reduce their cloud spend on data processing and data science. They spend or they save around 70 million of their cloud spend by switching from conventional computing, CPUs, to GPUs, to accelerated computing. And there are other examples, like, for example, Control Expert, subsidiary of Allianz, who are able to leverage NIMs. These are the inference microservices and other technologies in production. And there's Bunk. a challenger neobank that is able to accelerate the data processing by around factor of 5x, but also they could accelerate their entire training by 100x. So this means a frequent retraining of the models is indicated, it can be done, and this improves the false positives rate and improves their fraud detection systems. Last but not least, there are also many applications, new models, new Gen AI use cases in banks that are not only based on code or human language, but rather on generative physical AI, where you would sort of use physics AI to simulate future scenarios of our Earth in terms of how does the climate change, how is the midterm weather doing, will there be an extreme weather event coming up, and how could insurance companies and banks prepare for problems with their real estate, problems in their industrial insurance coming up, like risks emerging that could be solved with accelerated computing, where you are able to leverage these machines, these AI factories, sort of as a time machine, because you are able to simulate the future in a physically accurate way. This way, you get the full distribution and the extreme events of an, for example, extreme weather event like a tornado, right, or hailstorm or flood. This, by the way, is also very important now in energy trading. So a larger community has now started adopting these AI-powered weather modeling programs to improve their energy and weather trading. Another interesting application of accelerated computing, and I know that a lot of banks are experimenting here, is quantum computing. You can simply leverage a GPU cluster to simulate a quantum computer, which makes it much easier and more accessible to build software for quantum computers that run exactly the same on the GPU cluster as well as on the real quantum computer. So it's much easier now to execute experiments with quantum computing, leveraging traditional compute. And there are even open source frameworks out there that allow you to run experiments across a quantum computer and an accelerated traditional computer. Hybrid classical quantum computing is how it's called. And this is the way to go when you want to build sort of quantum classical computing, where you sort of have a lot of pre-processing with GPUs and post-processing with GPUs around the key operations or processing operations around quantum processing units. So that's one open source project. Another open source project that I have not yet managed is something that helps you to build trust into AI models. It's called NEMO guardrails, and this is exactly what it's doing. It puts guardrails, programmable guardrails around your LLM Gen AI application. And this is needed for building safe, secure, controlled, domain-specific digital assistants or other applications based on LLMs that are guardrailed. And this really supports the agenda in trustworthy AI model building. So in my last few seconds, I would highlight that AI is not something that enterprises can do or build alone. It's a team sport, right? So connecting to ecosystems, to platforms in AI is very important going forward. And here at NVIDIA, we are really at the core of an entire developer ecosystem with millions of developers, with developer programs, actually, with a lot of community and open source projects that we support, because AI is a team sport, right? AI is also something that needs to be tested, learning by doing, learning by failing. Basically, we have therefore implemented things like Launchpad, where people can just test an AI factory, or startups could join inception programs that we have, where they can just experiment with these things and get knowledge about accelerated compute to find out if that's changing the needle in their business model or not, right? And a lot of resources we provide out there for the developer communities, like Deep Learning Institute courses. There's also something called NGC. It's like a repository for downloading pre-trained models. Nobody needs to start from scratch. You can just start with a pre-trained model, then fine-tune this model. So NGC gives you a lot of open source models a lot of software and Helm charts and support to build your model very quickly. Again, we really help democratize AI, Gen AI, and accelerated computing. So this is really a team sport, as I mentioned. And there's one more thing that I would like to highlight. There's a conference called GTC. It's the largest AI conference globally, and I encourage people to attend it. It's free again, because there you will see state-of-the-art models, state-of-the-art use cases. You will see leading banks and other industries leverage accelerated computing platforms. They will tell you exactly how they do that. And there are several 100,000 registrations have been in the last one, so I expect similar ones or even tops here this March 2025. And companies like BNY Mellon that I mentioned, PayPal, Bunk, Control Expert, all these use cases that I mentioned that leverage accelerated computing and AI factories, they will present at this conference. So with this, I will close. I hope that this sort of exercise helped you understand where AI came from, where is it going, and how it will change everything. Thanks for your attention, and back to Judith.
Thank you so much, Jochen Papenburg, there, truly with a fascinating perspective as a scientist on how AI factories are being built and already deployed in financial services and beyond. And we do apologize for the video issues we had at the beginning, but they were quickly ironed out. So if you want to get an overview of AI adoption in banking, I suggest you keep your eyes peeled for the Evident AI Index report. The second one, it was launched last year with just 30 big banks, but the second one is due out on October 17, and it will include 50 of the globe's largest banks ranked on 4 critical pillars of AI capability: talent, innovation, leadership, and transparency. So now we're going to shift the perspective slightly, and we're going to take a hard look at the downside of AI and these other innovative fintech tools that we covered over the course of today and beyond, and look at what they are capable of in the hand of criminals. As Darius was saying earlier, it's quite clearly that over the recent years, 10, 20 years or so, cybercrime has been rising. And to put some numbers to that perception, according to the latest Global Financial Stability Report published by the IMF in April this year, since the pandemic, cyber attacks have more than doubled across all sectors. And the IMF says, given the volume of sensitive data and transactions, the financial sector is, and I quote, uniquely exposed to cyber risk, which in turn poses, again, I quote, a serious threat to financial stability. And the report goes on to illustrate that attacks on financial firms account for nearly 1/5 of the total, and banks are most exposed in that research. So the question is, are banks then ready for the next cyber attacks with ever-evolving innovations and technical tools that are also being used for cybercrime? And to answer these questions, I have the pleasure to introduce our moderator for the final conversation today. His name is Thomas Berger. Thomas is a partner and head of Luxembourg litigation and investigations practice at A&O Sherman. He specializes in domestic and cross-border litigation and pre-litigation matters within the realm of financial, commercial, and corporate law. He has a specific focus in professional liability in the financial sector, in particular in relation to fraud-related matters, to anti-money laundering and white-collar criminal law aspects. So, warm welcome, Thomas, and I hand it over to you and your guest.
Thank you, Judith. So our topic now, are banks ready for the next cyber threat? And I have with me the pleasure to have Pascal Steichen. Pascal Steichen is founder and CEO of the Luxembourg House of Cybersecurity. He has more than 20 years of experience For over 20 years, Pascal has been involved in the main cybersecurity initiatives of the Luxembourg government. He was a laureate of the Information Security Personality of the Year Award in 2017 and elected as the first chairman of the ECCC, European Cybersecurity Competence Center, in 2022. Welcome, Philippe. Pascal.
Thank you for having me.
So let's go directly into the topic. The financial sector, particularly banks, they are a prime target for cyber criminals due to the sensitive nature of the data they hold, of the valuable data that they hold, but also because of their activity. They hold valuable assets for their clients, be it cash, financial instruments, and they are a key player in any financial transactions. And as technology evolves, so will the methods of cyber criminals and the sophistication of cyber threats. But before to look into the future, my first question to you is, what are currently the cyber attacks and the cyber frauds that you see? And more generally, what type of cyber threats banks and professionals of the financial sectors are the target of?
Yes, as you say, I would say the banks are there where the money lies, and that's what the criminals are interested in, to get hold for the money. And obviously the banks themselves are targets, but what we see mainly in the last years, or I would say recently, is that it's more like the clients that are targeted by the cyber criminals, because it's easier to get a hold of a computer of an individual at home or of a small company that is not so good protected than a bank itself. Because what we see in the banking sector is that data privacy, security, cybersecurity is a topic since quite some time, and so the banking systems are, I would say, one of the well protected when we look at when we compare it to other sectors, and so the criminal adapted. They are focusing on the weak links, which is, as I said, the clients and the partners or the providers, but also which is also the humans involved in or working, the people working in banks, or the people working in companies that have their accounts, have their money at a certain bank. And this is what we see a lot, the focus on not on technology, not on IT systems, but on humans. So things like phishing, things like social engineering, where people's roles are impersonated in a company, and then others are forced or are motivated to do transactions, for instance, which in the system itself looks legitimate, but it has been initiated by a malicious, by a criminal intent.
And as a litigation lawyer, if I look at the last 5 years, for example, I have to say that I saw a lot of similarities in the type of fraud, in the pattern used by cyber criminals, although the sophistication may vary. So what about you? Have you seen fundamental changes in the tactics used by cyber criminals in the last few years? And do you think that what we are currently seeing, we will still see that in the future?
I would say there is some sophistication, but mainly on the, I would call it, on the efficiency of the attacks themselves. So not so much on the specific attack itself. So methods like using email to get into a company, so via phishing, or trying to get people click on a link, are things that are being done since 20-25 years, and it still works. But to produce those emails, they get more, the wording gets better. I would say it's more difficult to detect if it is a phishing email or not. So the criminals are using, I would say, also new technologies on their back back office IT system, so to say. That's what we see. But then we also see that, for instance, one other very prominent type of attack is ransomware type of attack, where the objective is to get the control of data of the company, so to block the company and to force them to do something, to react, to pay a ransom, to give money to the criminals. And there comes in the combination between a first attack on humans that need to click something, and then afterwards a sophisticated malware or a computer program that will then go into the network and from the inside block, so to say. So it's this combination which is the sophistication and which makes it also difficult to defend, because you have to do it on both levels, on the technical but also on the organizational, on the human. But conceptually, these things have been done since 20-25 years. So, but it gets more difficult to really efficiently protect against.
Thank you. Let's maybe now move to the banking ecosystem. The banking ecosystem is heavily regulated, and the cyber threats are more and more onboarded and taken into account by the legislation that the professionals of the financial sectors and the bank in particular must comply with. At EU level, we have seen the entry into force of DORA, the Digital Operational Resilience Act in 2023. We also have the Payment Service Package 3, which is currently discussed at EU level and that will also tackle, to a very large extent, cyber fraud risks. So my question to you is, what role do regulatory changes and compliance requirements play in shaping the cyber threat landscape for banks? And is it enough?
Well, first of all, I think the regulatory instruments are shaping quite a lot not only the financial sector, but in the area of cybersecurity. It's really an instrument. The regulation has shown being a useful instrument, an efficient instrument to bring up to scale up to certain resilience different sectors. And especially in banking, in the financial sector, there is quite a long history of such regulations. You mentioned PSD, we are in the third version of it. DORA is linked to something which is called NIS, which is NIS 2, in fact, so it's already the second regulation. So it's already ongoing since quite some time. And it really meant, the regulations are meant also to be not only focusing on creating obligations, on defining fees that need to be paid when obligations are not met, but really have an intrinsic so-called risk approach foreseen in the regulation. So the different institutions, the different banks, well, they are obliged to do risk management to identify what are the biggest impacts when it comes to cyber threats on the system, on their critical infrastructure that they are managing. And based on that risk, they then define the level of protection that is needed. So it's not we have to do this and this and this, but it's look what is really critical and protect the critical ones, the critical things very, very good, and the others, well, you can do it as a priority too. So it's really needs to be seen as a tool. And DORA is the new one, which has entered into force recently, which will be very active as of next year. So, and there we see really also some key elements coming into play, which has been a long struggle since some years to get along, and links to the ecosystem thing that you mentioned is what is called information sharing. So it forces, so to say, also the banks to not only keep the knowledge and the competence that they have created by identifying attacks, understanding attacks for themselves, but also sharing it with the others, with the ecosystem, the clients, the partners, the service providers, so that the whole sector can benefit from the knowledge and everybody can help each other. So that's the philosophy, and that's a very good step along, and it's really great to see that the legislator has gone this path.
Yeah, I agree. I think the sharing of information is really critical. You mentioned this risk approach. My next question is, while the banks are required to take into account and tackle the cyber threats, they are required to have safeguards in place. This is not necessarily the case of their customers. So banks are dependent on their clients and their awareness and readiness to cyber threats. Isn't it difficult for banks to be ready while others are not ready?
That's a good question. What is one I would say link when we look at DORA, for instance? As I said, it's connected to a more general legislation, which is a directive, which is called NIS2, so Network and Information Security number 2, which addresses 11 different sectors of the economy. To make sure, or to go into that direction, that the financial sector, well, it has a longer history. They are at a certain quite high maturity level, and to bring the others on this same level. And there again, information sharing is important because it is meant to be also between the sectors. So not only inside the sector, so inside the financial sector, but also that such knowledge about the threats, about the defenses also, can be shared among other sectors. And many of those entities in those sectors are clients of the banks, or maybe other service providers of the banks, or maybe are partners, are part of the larger ecosystem, not only the financial sector itself. So again, on the regulatory side, it looks quite interesting. It looks quite, the plan is there. Now it needs to be implemented. So that's what we will see in the next years, how this will work. But I think the tracks are well constructed, and the train is ready to depart.
Implementing the plan, this is indeed an important point. But of course, what we will also need is to onboard emerging technologies or trends. And in your view, what are what emerging technologies or trends are most likely to be exploited by cyber criminals targeting banks? In particular, do you see AI-related threats, as we talk a lot about AI, and how could they look like?
Yes, of course. I would say if we talk about emerging technologies and emerging threat links, there are two things that we have to talk about, which is first AI, of course. And the second is maybe a bit farther away, but which is all the quantum computing, the quantum computers coming, because they will threaten our encryption mechanisms that we use today. When it comes to AI is really, I would say, has multifacets. And when looking at AI and cybersecurity, there are basically three elements. Well, AI itself will help the banks and all others to do their security better, faster, more efficient. So it's a beneficial thing, and not only for cybersecurity, but for other areas as well, as we know. But it will, in the same way, also help the criminals to do their attacks and their intrusions more efficient, more effective, and harder to detect. And there we see a few examples or a few tentatives yet, but it's not yet fully in production, luckily. But we see like phishing or like these social engineering elements where AI is used, where voices, for instance, are being reproduced, and to make those person impersonations more efficient. And then the third thing is AI is technology. We need also to secure the usage of AI itself, and to avoid that while using an AI infrastructure, that through that you can attack a company. So that's really the three elements. On the cybersecurity side, we are focusing on the third part, how to secure AI technology in the future. And there are more and more guidance coming out at European and also at national level. For instance, very recently, the German and the French cybersecurity agency created a joint venture to do a joint guidance for this topic.
Okay, so now my last question, the big open question. How can banks enhance their capabilities to better respond to future cyber threats?
One important element is wanting to become better is, I would say, train, test, strengthen the competences. And there again, in going back to DORA foresees and even creates an obligation of testing solutions, of having continuous improvement cycle. And this is a quite important element, because even if cyber is about technology, the solution lies mainly at human and at organizational level. So we get the people, we need to get the people up to speed and have the right competences. So this is really where I see the biggest efforts that we need to do.
Thank you, Pascal, for this very interesting discussion. We could have talked hours about it, but now handing back to you, Judith.
To be continued, Thomas. Thank you, Thomas Berger and Pascal Steichen there, with a perspective on cybercrime and how to build cyber resilience. To be continued indeed, but for today, the inaugural Digital Finance Forum is drawing to a close. We hope the insights provided by our expert speakers are of value to you. We seek to continue the conversation at another time, but for today, I would like to invite you to revisit the replay and listen again to some of the insights. There was a lot in there in those 3 hours, and I apologize for running over, but some of the discussions were so rich, we let them continue just a few minutes more and then it piles up. Of course, the email with the direct link to the recording will be in your inbox shortly. And I also encourage you to look at the report that Darius and his team at PwC Luxembourg put together for you with the title Open Finance, Genesis of a Revolution. You can access it right here on the event website. It's free to read and has a lot of good data and reference points and strategic advice. And of course, if you wish to get in touch with Luxembourg for Finance on social media, those are the possibilities on LinkedIn, on X and on Instagram. And I suggest you keep your eyes peeled, because there are lots more events coming up in the near future, also with a look towards 2025. Finally, on behalf of Luxembourg for Finance, I want to express our gratitude to our sponsors, to our fantastic speakers, and to our audience who have been joining us from more than 50 countries. It's been a privilege to be with you. I wish you an excellent day ahead and say thank you and goodbye until next time. Bye-bye.